Good morning. Welcome to the Heritage Foundation and our Douglas and Sarah Allison Auditorium. We, of course, welcome those who join us on our heritage.org website and those who are joining us on C-SPAN on a future occasion. We would remind everyone in-house to check that cell phones have been muted. And for those online, we remind them that questions or comments can be sent to us at any time, simply emailing speaker@heritage.org. Hosting our opening discussion this morning and the rest of our program for parts of it today is Paul Winfrey, Director of our Thomas Rowe Institute for Economic Policy Studies. Paul returned to Heritage this year after serving as Director of Income Security Policy at the U.S. Senate Committee on the Budget. Prior to joining that committee, he had served here as a Senior Policy Analyst in Simulations in our Center for Data Analysis. He has additionally served on the World Economic Forum Commission to study alternative measures of economic performance. He also specializes in health economics and applied econometrics. Please join me in welcoming my colleague, Paul Winfrey. Paul?
Thanks, John. We're pleased and honored to have with us today Dr. Alan Rabushka. Dr. Rabushka is the David and Joan Traitel. Did I get that right? Yeah. Close enough. Senior Fellow at the Hoover Institute at Stanford University. He is a world-renowned expert in a number of areas, but especially taxation, having served on President Reagan's Tax Policy Task Force. Dr. Rabushka is also the intellectual father of the flat tax. Dr. Rabushka has a bachelor's degree from Washington University, St. Louis, and a PhD from Washington University. Please join me in welcoming Dr. Alan Rabushka. So thanks. We've got Alan and I are going to engage in a little bit of a discussion here, and then we're going to open it up for questions. But first of all, I'd like to welcome David to our tax reform talk show. I'm sorry, we don't have a live band to play, but if you want to play some games at the end of this, like smashing eggs on our foreheads, then I'm open. So let's get this thing kicked off. In your seminal book with Bob Hall on the flat tax, you wrote that economists and politicians of all persuasions agree on three main points. 1, the federal income tax is not simple. 2, the federal income tax is not costly. And 3, the federal income tax is not fair. Can you elaborate on these points for us?
Sure. For those of you who may be interested or haven't seen any of the versions of the books Bob and I have done, we managed to condense a flat tax law into 4 pages, largely self-explanatory, which means a minimum of regulations. But we're somewhere, 60, 70, 80,000 pages. I forget how many, but it grows topsy. So anybody who thinks that's simple is missing the point. But so many stories over the years. Some entrepreneur, not too complicated, takes his tax return to 7 different tax offices and gets 7 different tax results. So that should be a problem for tax professionals. And then all the difficulties in interpreting things makes for enormous complexity. And then all the various gray lines. So every time there's another tax measure to simplify it and clean it up, it gets worse. And among my favorite phrases was Bill Archer, who kept talking about tearing the income tax out by its roots. And by the time he got done, the roots were deeper, larger, and sucking in even more water. So part of the problem is that it just gets worse and worse and worse. Now, what does it cost us? I was invited in 1984 to serve on the American Bar Association's Commission on Taxpayer Compliance. And we had 3 former commissioners, some professors, some tax experts. And we produced this lovely report over 2 years. It was about 100 pages long, single-spaced. We had a staff of experts to help us out. And we went through every single thing we could figure out why there's $300 or $400 billion of taxes that are owed but not paid. And it's very hard to prove in any way scientifically what the main cause is, but we could all agree on one cause. The higher the rate, the greater the noncompliance. The lower the rate, the less the noncompliance. So the only unqualified, with no hesitations or reservations, recommendation of the task force was have lower rates. And so if you think about cost, what do we have? We have, I don't know how many $100 billion in unreported income because people are trying to avoid taxes by underreporting income or exaggerating deductions. We have tax plannings, tax lawyers, tax accountants. My favorite statistic when we wrote the first book in 1983 is the number of people who practice law in New York City versus Washington, D.C. And we found in the early 80s that the number in Washington had grown so rapidly that they caught up with the number in New York City, except the number of lawyers in Washington didn't really practice law. They practiced various forms of advising people on tax policy, expenditure policy, and so forth. So we've created this massive industry. And in Silicon Valley, before the bust, I remember talking to 400 financial planners. And all but about 2 or 3 said that with a tax rate below 19%, they'd have to look for other work. But because we had high rates of 40 and 50%, basically, remember, $1 saved in taxes is $2 of producing income. Way better to concentrate on saving taxes and producing income where you're at some margin where you can choose one for the other. You know, so simplicity, complexity, cost, rates, the whole package. And it's not fair either. I mean, if you think about it, we have a wonderful legal system in this country that's gradually evolving. You're not supposed to, or you're legally not supposed to, discriminate on the basis of age, sex, gender, race, religion, ethnicity, handicap. But tax policy discriminates against every single person by affording each individual different kinds and different amounts of deductions and exemptions and rates. And so we have a tax code which is the very essence of discrimination, which seems to me to fly in the face of the 14th Amendment. So anyway, that's, I think, a good way to begin discussing the topic.
I mean, it seems like there's a tremendous opportunity cost to the human capital that goes into both evading and avoiding taxation. Because it's not like the tax accountants and the lawyers and everybody else who works in D.C. And just by sharing, how many folks in here work? I mean, probably most people in here work in the tax world. But how many folks in here are tax lawyers or tax accountants or have JDs and work in the policy world? Oh, so not as many as I thought. Just David over here. Yeah, so that's a big enough of an opportunity cost in and of itself. So.
I should also mention the problem with high taxes is that we can't quantify foregone opportunity. For example, under a simple flat tax, I'll give it a shot. Under a complex high tax system, say I'm a C Corp person and I'm going to pay at the personal income tax rate, may not be worth the effort to try to go into business on my own. Because if I really succeed, they're going to grab such a large chunk of it. So we end up deferring opportunities, and those we can't count because they're unknowable and invisible. We can just try to estimate what they might be if you had a much lower rate. So there's a whole range of visible and invisible costs associated with the current code.
That's right. So let's talk about this issue of fairness for a minute. So many on the left and right think that the graduated marginal income tax rate system that we have today implies progressivity, when in reality it doesn't. Rather, progressivity is this function of average rates, not marginal rates. Can you go into a little bit about how the flat tax is more equitable than our current system?
Yeah, actually, I did have one set of numbers that I can't remember, so I wanted to bring with me. I did an assessment of something like 202 political jurisdictions around the world to see every single one of their income tax systems. So here's what I found. 16 have no personal income tax, the oil sheiks, the offshore havens. 45 have a flat rate, of which about 36 or 37 we can trace from our book. So I've got a desk in my office where I have flags from all the flat tax countries. It's a nice picture. 23 have 2 rates, 118 have 3 rates. So clear, and not only that, but these rates aren't the same. I mean, they're different everywhere and they change over time. So if someone wants to tell me what's a fair tax, I want to know how you pick out which of these 218 is the fairest. And it won't sit still long enough not to change anyway. And this is just rates, not base, not deductions, not exemptions. So the notion that a particular system is fair and all the others aren't is just a matter of your personal choice at the end of the day, or what you can politically get away with and enforce. So fairness. The way I like to think about fairness is that you can have a progressive tax on a single uniform rate. So I did the numbers at one point to illustrate this. So let's just take, for example, and say an individual has a $20,000 exemption. So up to $20,000 of income, you have 0. Then if you go to 40,000, you're paying 10%. and you go all the way up until you're making about $1 million, say, and you're paying 19.99999. So you run your way up from 0 all the way to just about 20, depending on your level of income. So you can vary the personal allowance, make it higher, okay, and that way you would have a greater degree of progressivity, or you could lower it and maybe make a smaller degree. But at the end of the day, as long as there's a personal allowance or an exemption or deduction in there, it is progressive. So the question is, what degree of progressivity do you want? Well, if you decide to have tax rates going all the way up to 50%, you can be sure in response that the Congress will, because it always has, give high-income people special treatment because people don't pay 50% tax rates. Very few do. And so what happens as those rates go up is you end up with a tax code that gives special deductions to startups, special deductions to various kinds of sectors and industries. And when you talk about fairness through marginal rates, you have to deal with the fact that you're taxing different entities at different rates too, from personal people to professional corporations to business enterprises and the like. So my view of this is that it's impossible to consider a flat rate with no deduction where everybody starts at the first dollar of income. But once you hit that threshold, a flat rate allows you to have a simple, fully integrated, progressive consumption tax. I'm going to repeat that again. A fully integrated, progressive consumption tax. There's a lot packed in there, and I'm sure we'll talk a little bit about it, that achieves the goals of having a consumption tax base, plus an element of progressivity, plus full integration of business and individual tax rates without double taxation. And I think that's the beauty of having just 2 postcards to do it, and it's the reason for 2. But fairness then under that situation will treat people pretty much the same because everybody's taxed the same on their last marginal dollar of income, and everybody, depending on family circumstances, receives the same personal allowance. Now, you may think you want to give preference to one group over another. Fine. Vote for it openly on the budget in the form of financial transfers. Why is this a problem? You're on the record of voting for spending money. But if you hide it in the tax code, you're not on the record voting for spending money. It's way more complicated to say you're the equivalent of spending money by providing tax deductions that narrow the tax base. So, I mean, I think one can make the argument the flat tax or any flat rate system really is about as fair as you get in terms of treating people equally. Some people don't want to treat people equally. That's their political view.
In your book, you have this great, speaking of this, in your book you have this great quote from John Rawls in The Theory of Justice about how an expenditure tax applied across a broad base is probably the most equitable tax imaginable. And John Rawls is, I think it's safe to say, is not necessarily a conservative. And anyway, so I thought that was very fascinating.
Behind the veil of ignorance,
Right.
if you don't know what your life's going to be,
Right.
why not everybody have exactly the same tax system that they're going to face,
right.
rather than determine in advance what tax system you're going to face?
That's right. So you spoke a little bit about a consumption base, how it's important to have a consumption base. And so for folks in the room who maybe aren't as familiar with that, basically a consumption tax is a tax on income spent on consumption, but not income that's saved or invested. Can you explain or go into a little bit of detail about why having a consumption base is so important?
Basically, a way I like to think about it is if you just use the very simple formula, the gross domestic product equals consumption plus investment plus government services, which is small, forget that, and then net exports. If you net out investment, you're left with consumption. So what's investment? It's whatever you do that you invest to make your business activity more productive. And having first-year write-off of investment spending gives you the maximum incentive to make that investment in the first place, and then also changes the tax base of GDP to purely consumption. So economists, generally across the board, agree that you get better performance in the economy by taxing consumption and not taxing new investment. So that's the basic core argument on that. Now, there's always going to be differences among people as to how much better the economy will perform. Will it be 0.1%, 0.5%, 1%, 2%? But I'm not sure I know of anybody who says it's negative. That is, everybody says it's positive. We don't know what the slope is, whether it'll be small, middle, or large, or the coefficient. But we pretty much agree it'll be positive. And what that means is in the long run, as we accumulate capital, we get more productivity, worker wages rise, and so forth. And so you do get a benefit over the longer run. So imagine that if you could compound growth at 4% instead of 3%, how much more rapidly you would double real income. So it becomes very useful to think in terms of long run rates of growth, and you will get higher growth rates over time on a consumption base.
So can you talk a little bit about why marginal tax rates are so important for economic growth and real income growth?
People work for themselves, not for the government. I know of very few people, especially rich people, who sit down each day and say, what can I do to reduce the national debt? You know what I'm going to do today? I'm going to write a check. There's a special office in the Treasury where you can send that check to. I don't have the zip code for it. Where
Nobody works there.
It's called paying down the national debt. And I think every now and then they get a check, which they always highlight. But most people work for themselves, which is quite fascinating. And think about this. You have billionaires who go out of their way to make sure they're not paying ordinary income, but carried interest on certain transactions that I think should be taxed as ordinary income. But that's Schumer's district, and he gets a lot of money from those people, so that continues to survive for the time being. But basically, as the tax rate rise, Ronald Reagan figured out very early, and I guess it's old hat to use him, that by the time May come, he was paying 91%, so he quit working the last 6 months of the year. And there's a lot of situations where when your tax rate goes up, you begin to think a little bit about, is it really worth it? Now, it may be worth it at 50 cents on the dollar. Is it worth it at 20 cents on the dollar? The other thing is the higher the rate, the more likely you are to avoid and even evade. And so one's legal, one isn't. And the line between the two is often a very thin judicial decision. So one of the things we discovered in marketing the flat tax around Europe, and we discovered this in Romania and Bulgaria and elsewhere, is they used to enjoy these high marginal rates of 20, 30, and 40. And they dropped them to 10 and 16, and they made some estimates about the underground economy. And they figured out, well, so much is underground, and so much will become legal, and they can buy insurance and get bank loans. And they estimated in the first year they would recover so much revenue. They typically got that much revenue and more in the first 9 months because you had such a positive response to people coming on board and only paying 10% or 15% or 16%. So high marginal rates really create all kinds of problems for all kinds of people. And so the lower the rate, the higher the after-tax return. And most people, as I say, work for themselves, not for the government.
So there are a lot of congressional staff in the room, and one of the issues that's being debated right now in Congress is the Highway Trust Fund. And one of the ways that both the House and the Senate have proposed to pay for the Highway Trust Fund shortfall is through additional tax compliance measures, which would, almost by definition, increase the complexity of the tax code. What would you tell a member of Congress who is looking at additional compliance measures relative to, say, overhauling the code altogether?
Generally speaking, I would tell them low rates on a broad base reduces the incidence to avoid or evade taxes and add simplicity to that, and you have less need of compliance. The United States is a pretty good country for people paying taxes, and we get a really good response with lower rates. We get not as good a response with higher rates. So any measure that's going to increase complexity is just going to make people more unhappy with every aspect about taxes. There's a story I like to tell, which is if you're in a residential neighborhood and there's a lot of small kids and some car goes speeding through at 60 miles an hour and you catch the license plate, you're going to call the police and try to get that person apprehended. But if everybody in the neighborhood is more or less honestly paying the tax code and they learn a neighbor's found some way to cut their taxes by half or more, nobody calls the IRS. They go over and ask him how he does it. So I think this gives you some indication of how people respond to the IRS. Yeah. And generally speaking, you know, when you sit around a bunch of people at a tax conference, an IRS conference, after hours in the bar. So what are you doing lately? What have you found? You got a lawyer that's found some special thing for you, or how are you avoiding the high inheritance tax and so forth? They don't talk about, let's go out and march for more compliance.
Yeah. So on the White House website, President Obama has laid out a series of principles for tax reform. Those principles include 1, lower marginal rates, 2, eliminate inefficient and unfair tax breaks, 3, be part of a deficit reduction effort, 4, increase job creation, and 5, remain progressive.
Well, as I've said, the Rabushka flat tax is a fully integrated, broad-based, low-rate consumption tax that, over time, to the extent it aids economic growth and reduces noncompliance, will generate additional revenue. And if we can somehow or other stop the Congress and President from spending every dollar it gets and 10 cents more, it would, over time, reduce the deficit. That is, a faster performing economy and a less rapidly growing government will give you additional revenues. So I say they're all terrific, but governments don't create jobs. They get in the way of job creation. So I would certainly drop that category. Let the business community and individuals form their own businesses and create jobs. I wouldn't focus on the deficit reduction part of it. I would just try to freeze spending, because if you try to focus on cutting things, you end up with all kinds of people telling you why you shouldn't. But otherwise, I think it's right on the mark. It's just too bad they don't do what they say.
Mm-hmm. So basically, so the president's comments don't poison the well on tax reform.
No, they don't. But I've noticed that Mrs. Senator Secretary Clinton today is proposing things that do. And so I'll leave that to later questions and answers. But I would just put it this way. She couldn't be more wrong if she tried in raising capital gain rates, and in particular holding long-term investments. I live in Silicon Valley. 9 out of 10 startups fail. We're not interested in long-term preferences. We're interested in getting on and getting out and exiting to finance more of these things. So the whole notion that somebody's going to actually sit around and hold things for 5 years to get a lower rate is just plain silly.
So one of the really significant and sort of inside the beltway accomplishments that Congress has had in the last 6 months is the adoption of the dynamic scoring rule by the congressional budget. You've written in the past that to dispute that higher rates discourage economic activity is to repudiate the one genuine law of economics, the law of demand, which stipulates that prices and quantities are inversely related. How do you think, or do you think, that the new dynamic scoring rule that has been adopted by Congress, does it help the eventual passage of the flat tax or acceptance of the flat tax?
Well, there's probably 50 different factors that would go into getting it passed, but it certainly would help it. There's going to obviously be a huge debate and quarrels, as there already has been, on what the degree of response will be. That is, will it be small, medium, or large on some metric? So we're pretty sure there's going to be some response. I think in this case, the notion of income effects outweighs substitution effects. That is, people get rich quicker, they stop working. But I don't think there's any doubt that there's going to be a whole lot more people working, investing, and doing things to get richer in the first place. So I think what one needs to be careful of is not over-exaggerating the benefit of it just as a political measure, but take some small, if you can get a consensus benefit, because it's just going to have a long-term cumulative impact. Sure. So as I've said, even if you could only get a 0.5 percentage point increase in the annual growth rate, clock that over time, and it makes an absolutely huge difference.
Significant. So we have a few minutes for questions.
Can I talk about the, we're going to do that
we'll
at the very
do that
end.
later. Yeah.
Okay. Great.
So we have a few minutes for questions. If anybody has any, there is a couple of microphones. Just please state your name and affiliation, and then state your comment in the form of a question. Yeah.
Hi, I'm Nick Farmer. Can you comment on the idea of having a pure consumption tax, a sales tax, VAT, whatever you want to call it, flat, replacing all other taxes, business, corporate, personal, payroll tax, and keeping the progressivity of our current system with a rebate to individuals to replace all of the various income transfers that are embedded in the federal budget. Do you think that concept would work well and be much more efficient?
What you've done, of course, is just describe the fair tax. And we had Governor Huckabee out at the Hoover Institution 3 weeks ago, and Bob Hall and I tried to budge him off of it a little bit in favor of the flat tax and didn't get anywhere. But I wrote a piece once called A Friendly Case Against the Fair Tax, Why It's Not as Good for America but Great for Me. And I just want to give you a couple features of that. In the 1960s, there were 12 European countries with a national retail sales tax. By 1980, there were 0. All had transformed themselves into a value-added tax. And the reason is a value-added tax is more or less self-enforcing up the chain, and so you can collect it, whereas a retail sales tax is prone to cheating. I will tell you my early personal story in 1981. I was having dinner at a restaurant in Rome, and on the way out, the cashier said, now listen, we're not charging you value-added tax, but sometimes the police are outside the restaurant checking receipts. So if we see someone coming up to you, go ahead and show them the receipt, because one of us is going to run out the door right there as fast as we could. I'm sorry, sir, we gave you the wrong receipt. And after a while, it turns out that proprietors get very good at doing this kind of thing. And so you're going to lose a whole lot of revenue in that process. And retail sales taxes are very hard to enforce across a whole country. Now, a second matter is we also have a retail sales tax in some of the states as well, so tack that on and you're going to have a fancy rate. But there's a number of other aspects of this that are kind of small, but they start to add up. I'll start with a joke, if I may. I hope all of you have seen the various Star Trek series. My favorite characters are the Ferengi, of course, who live for profit. And I have this little book called 216 Rules of Acquisition, and Rule 183, if I remember, is only fools pay retail. So that was one. The second thing is that I don't know how many of you come from large, extended Jewish or other immigrant families, but there was always an uncle in the family who said, no, I'll get it for you wholesale. And so there was no tax there. And then, of course, you have a rush to set up small businesses. So you become a C Corp or whatever, and then you get your sales tax license from the state, and so you don't pay retail sales tax on your inputs, which in the worst economic situation in Belgium in early '81, there was a proliferation of restaurants because people were eating on the restaurants. That is, they weren't paying tax on the food they consumed. The next thing is, for me, it's terrific. My house is paid off, my car is paid off, I have all my consumer durables, I live on my cash flow, and my successful kids are in exactly the same situation. We consume such a tiny proportion of our budget that it would be way better than the income tax, or even a flat rate income tax in affecting us. There's another little aspect of this. When you add a sales tax increase to any state or entity, it goes into the CPI, it raises the consumer price index. Do it Hall Rabushka style on the flat tax, and what you end up getting is you get a value-added tax, you get the equivalent conceptually, but it looks like an income tax and it doesn't have any effect on the consumer price index and so on. So this is just a bunch of these things that get in the way and complicate it. So prebate's also going to be a problem because you got to know who's eligible for it. How are you going to know that? Anyway, so what I think is my biggest fear is that if you were to do that, the probability that the Congress would overnight swap one for the other, I believe, is low. And the answer would be, let's start at 3%, see how it works. Then let's raise it to 5, 10, 15, and when we hit 30, we'll get rid of the personal income tax, corporate income tax. No European country has done that. Not Japan, not Korea, not Taiwan. They all start low, first with 3, then 5 and 10, and they haven't reduced the income tax. So it's no accident that in Europe they spend 50% of GDP and we spend 30, 35. It's because they've gone that route and you end up not with a replacement, but an addition. It's very hard. You know, there's so many programs you need to finance that Congress would never agree to an overnight swap, whereas there's not going to be, and by the way, transition, in our very first book in 1983, it became a big problem. So we had a transition section subsequent, and our sort of rule, it can be varied as 5 years. Okay, so you can have 5 years to cling to the old system if you've got a lot of unused depreciation. But if you want to go to expensing, do it right away. And we figured out about 80% plus of all enterprises would go right away to the expensing. And at the end of the 5 years, there's not going to be much depreciation worth anything anymore. And certainly for startups, it's fantastic. You know, write off as you go and carry your tax losses forward, and then you can draw them down when you're profitable. So in many respects, I'm not persuaded. I'm not influenced. And the Bush Commission had about an 80-page review of fair tax, national resale tax, and there's a lot of problems in it that they add to it. So might be better than the current system, but only if we had a constitutional amendment which guaranteed a 100% simultaneous replacement. Otherwise, I would be very nervous.
You know what?
Oh, did you want to follow up?
Well, I was just going to say, I just learned out of that I can move to Rome and start a business printing fake restaurant receipts and apparently make some money. So.
Well, that's why 25% of the economy is estimated to be underground.
Yeah.
And 50% of the entire population between 15 and 24 is unemployed.
Hi, I was wondering if you wouldn't mind going into a little bit of detail contrasting the flat tax with Hillary Clinton's proposed tax plan, and why the flat tax would be better.
I don't know what her tax plan is because she hasn't spelled it out. She's hinted at what it will be. It'll be higher taxes on the wealthy, and I think maybe 50% marginal rate over those over $1 million. And let me digress here to throw a little cold water on that. The best-selling economics book in, 50 years, Capital, 21st Century, Thomas Piketty. He organized a letter signed by 250 French economists in 2012 saying they supported Francois Hollande because he wanted to put a 75% personal income tax over those earning over $1 million. And lo and behold, January 1, 2013, he did. And then comes the end of 2014, and the thing is scheduled to expire. And he lets it expire. What? A socialist? So Piketty turns down the French Medal of Honor. And then, to make matters work, he resigns from the French School of Economics in Paris, which he himself founded. He moves to London, where they have the Center for Inequality, and they're more open to this stuff. So works in theory, but not in practice. And then, of course, the British Labour Party was running against Cameron, and the polls showed them even until the last day. And Labour said, we're going back to that 50% tax ban. And they got slaughtered, of course. And then just a week or two ago, the new leader, whom you've never heard of the Labour Party, unless you watch Prime Minister's Questions, tax issue is settled. No more talk about a 50% marginal rate. We're happy with 45. And we're going to let the corporate rate go to 18. And we may even see some personal rate reduction. So out there in the real world, people who have either tried it or who are advocating it gave it up and don't want to talk about it anymore. So there's not much stomach for actually doing this stuff. And I think it's really important to remember why the rates all went down so high from the early years. And when you like to talk about 91% under Eisenhower, nobody paid it. 92% of the people were paying, like 20%. So we're talking about a tiny fraction. We're not talking about, a third of the middle class paying these very high rates that will hit them today. She's talking about high rates of tax on capital gains. Capital gains are just a double tax. If it's in the form of dividends, it's a tax on after-tax profits that are distributed. If it's on capital gains, it's an after-tax gain profit on the higher stock price due to retained earnings. But in any case, as we approach creating a tax base, we use GDP. And for those of you who know how that's constructed, you don't find capital gains in GDP. So if you're going to have a GDP consumption-based tax, there's no basis for taxing capital gains. And then you end up into hybrid systems with income and double taxes. So we went out for the lowest rate. Now, if you had, say, a 9% rate and then another 9% on capital gains, then the double tax rate would only be about 16%, and it would be prohibitive. But if you're going to start talking about a 39.6 or a 50% tax, throw in California and New York, and you're 60%. And then talk about a 50% tax on capital gains and, 25% tax on dividends, and you earn $1 million, you're paying, 75, 80% marginal tax rates. And That's when companies start buying cars for everybody instead of you buy your own car with your after-tax income, because that's a tax-deductible expense. And then we go back to 3 martini lunches and 3.5-hour work breaks. So what you will end up is distortions, inefficiency, complexity, and lobbyists, and it's just the wrong way to go.
Yes.
Wait for the mic, please.
I have maybe a technical question. I think it is a technical question. You mentioned that you figured that 80% of businesses would choose expensing given the option. Where did you get that figure?
This went back to the early 1980s, just looking at the nature of investment. For example, we had drawn out depreciation schedules for construction, for buildings. But imagine you can put up a shopping mall and write the whole thing off in the first year. So what you're going to have is all new investment spending is certainly going to come under the new tax code. And then what you would have to do is look at the value of unused depreciation. And so for some companies, there might be some calculation where you have to think about if you're going to make new investment, the benefit of writing that off versus maybe losing some of the depreciation of your old investment. The people who would benefit for those who were just absolutely stagnant, not planning much in the way of investment, and are going to just slowly depreciate their old investment. And that looked to us based on our assessment as a small minority. Certainly in the tech world, there's no case where you prefer depreciation to first-year write-off. In the case of small business, there's probably no case. And since most new jobs are created with small business, I don't remember the exact number, 80%, something like that, you're certainly going to get a better stimulus to small business and jobs growth by having full investment spending. You know, Section 179 that we managed to get up to $250,000 is basically what we're proposing for the entire tax code. It's across-the-board Section 179 for all new investment. But interestingly enough, if you look at investment in physical plant and equipment, we're actually producing more with less. I mean, the share of our economy that's manufacturing is smalling, but the output value is still higher than it was when it was bigger. So we're getting into a situation where it's almost going to be obvious to anyone that you want to take the expensing route. And after 5 years, it's going to be pretty hard to find very many businesses, if any, that are going to go 6, 7, 8, 9 in terms of writing off the rest of their depreciation. So I think that's the principal benefit. Not only that, and I should tell you a little bit about how Senator DeConcini and Stephen Sims became really the first supporters in the Senate of the Hall-Rabushka bill. It turns out Dennis DeConcini, a Democrat, his family controlled property. And they had 48 separate properties, which were set up as 48 separate companies. And they were all under 48 separate depreciation schedules. And he looked at me and he said, "You mean I can tie all of these together and just put one line on a tax form?" And I said, "Yep." And he said, "Sign me up." So that's how we got Democrats. And in 1982, there were more Democrats supporting our plan than Republicans. And as a joke, the Wall Street, it was the New York Times, came out on April 15th, 1982, and wrote a strong positive endorsement of our flat tax. And the secret was it was Bob Hall's economics student. But anyway, so I have the actual quotations from Washington Post, Wall Street Journal, New York Times, 1982, and then the story changed later. But I want to make one other point, which the questions haven't brought up. Economists think more about efficiency. They think about equity too, but they think about efficiency, and they talk about neutrality and not favoring one industry over another. And as I look back over 34 years of doing this stuff and marketing it all over the world, what I would say is that in the United States, we may have understated or underplayed the importance of simplicity. Whereas when you look at the post-Soviet countries, starting with Estonia, Lithuania, Latvia, and then Central and Eastern Europe, they regard simplicity and compliance and understanding and online reporting in the same way they regard low rates as conducive to their economies, high growth, strong revenue growth. And I think here, particularly among economists, we can't stop talking about efficiency, and we don't talk about simplicity, that is ease of understanding, ease of compliance, ease of collection, ease of promotion of the idea you should pay, and at a low rate and simple. Our very first book was called Low Tax, Simple Tax, Flat Tax. We changed the title to Flat Tax. We discovered people couldn't keep three concepts in their mind at the same time, particularly in the Congress. That's the old can't walk and chew gum, except there were three things they had to do. And so then we would go on to claim that it was a low rate, a simple tax, and it was flat. But simplicity is really important, and I would think any of you who want to get on the bandwagon, I think it is important to stress that we've got to keep it simple, because otherwise all we're going to have is increasing complexity.
So if folks want to know a little bit more, how can they do that?
Okay. The good news is you can get the flat tax book free online, so let me tell you how to do it. The easiest way is to Google my name. My Hoover homepage comes up first. You will see in the brief description about me in the first paragraph, the words "the flat tax" are underlined. If you click that on, you will go to the Hoover Press page where you'll see the flat tax book. Each chapter can be downloaded and printed free of charge, as many as you like. Print 1,000 and give them to your friends. On my same homepage, there is a link to my flat tax blog called flattaxes.blogspot.com. And what you will find in there is I've tried to chronicle the history of the flat tax movement all over the world. As I've said, there's 45 jurisdictions that now have it. And I've written about every one and what their rates are on the latest updated list, which I just put up of the 45. And it goes back to 2008. There's 120 posts. So if you really want to follow it, go back and you can read all 120 and you will know the entire history of the flat tax movement all over the world. And every time there's a change anywhere, I put it up, and I usually put up an end of year update on that. On that same flat tax blogspot page, you'll also see a picture of the flat tax book. So if you couldn't find it underlined, click on the picture and you get to the book free of charge. It won't look like that because it's the newer hardcover version with an introduction explaining how it spread to 25 new countries. And by the way, just a short note on that, why is it that these Baltic countries and others went to a simple flat tax? Well, under command and control of communism, the state gave out the money and collected all the revenue. So when the wall came down and they needed to go quickly, the easiest thing was a short, simple form you could do online, and they needed to collect revenue on a market economy literally in year one. And then some of the other countries wanted to follow Western Europe, originally Russia, Czech Republic, and all these others, and after about 7 or 8 years, they threw in the towel, and when Russia went to 13%, they literally tripled taxes in 7 years on real inflation-adjusted terms. And so that's when the bandwagon started all over the world. So I'm still trying to market this. There's a big movement going on in Italy, which we don't have time to get into, but it's my great hope that we'll see something happening in Western Europe. Anyway, that's how to get it. And the best way to reach me, if you're media or if you want to talk, is email me with questions, and I'll take the time to answer them. But the back of our book, the last chapter, has 66 questions and answers, and they were the 66 most common questions that we heard over about 15, 20 years of interviews. They're 1 to 3 paragraphs, and they're designed for quick, easy understanding things. And if you don't want to read the plan, read the questions and answers, and you'll get it. And if you come up with a new question, you get bonus points.
Yeah. I'll say the Q&A section of that book is absolutely fantastic, and I encourage everybody to go out and download a copy and or 1,000. And,
and give them away on the corner.
And give them away on the corner. Everyone, please join me in thanking Dr. Rabushka. So I'd like to introduce my colleague, David Burton. David is a senior fellow in economic policy at the Thomas A. Rowe Institute for Economic Policy Studies at the Heritage Foundation, where he focuses on tax matters, securities law, entitlements, and the regulatory and administrative law issues. His career in financial and tax matters includes posts of partner in the Argus Group, vice president for finance and general counsel of New England Machinery, manager of the U.S. Chamber of Commerce's Tax Policy Center, and general counsel at the National Small Business Association. Burton received a J.D., being our apparently only lawyer here, from the University of Maryland's Law School, He also holds a Bachelor's of Arts degree from the University of Chicago. Please join me in welcoming David to the podium.
Good morning. The purpose of this panel is to discuss the essentials of good tax policy. And we have a very strong panel today with 5 of the country's leading experts and proponents of fundamental tax reform. Each panelist will make a presentation of about 10 minutes, and then we'll have questions and answers from the audience. The entire session will last about an hour and 15 minutes. Now, the broad principles of tax reform are something that most informed conservatives and libertarians generally agree about. The economic principles of sound tax policy are driven by the findings of the public finance literature, the optimal tax literature, and price theory and microeconomics. They're all, and those principles could be summarized as the tax system should raise the amount of money necessary to fund limited government in the least economically destructive way. And in more formal economics terms, in the way that minimizes the deadweight loss or the excess burden associated with raising a given amount of money. What this effectively means is a flat rate consumption tax. Now, as you'll hear about in some detail by the panel, there are 4 types of flat rate consumption tax that have been proposed by conservative politicians over the years. The Rabushka flat tax is one version of that we just heard about. There's also what is sometimes called the new flat tax, or a consumed income tax, expenditure tax, cash flow tax, and that also has been introduced in Congress, although not in the current Congress, I believe. There's 2 other methods. One is called a business transfer tax, and the other is, of course, a national retail sales tax, the best known of which is the fair tax. Now, the magnitude of the economic gains to be had from moving towards any of these approaches is very, very large. Steve Enton in particular is going to address this subject, but fundamental tax reform has the ability to positively transform the American economic landscape. It's probably the economic policy program that has the most represents the greatest opportunity to improve the standard of living of the American people and to recreate prosperity in the United States. A second principle is that the tax system should have the least negative impact on the core institutions of civil society. That would include the family, but also voluntary associations such as our religious, charitable, educational, and civic institutions. Alexis de Tocqueville and Robert Nisbet have written eloquently and persuasively about the importance of these types of institutions to the success of a free society. Now, the third is to help preserve our rights to life, liberty, and property, and to further the cause of fairness and justice. The tax system should impose no unreasonable burdens on individuals and apply consistently to all Americans with special privileges for none. It should also respect taxpayer rights to due process. Now, 3 papers have been made available to you today, and those of you who are watching either on C-SPAN or on the webcast, the papers are 4 conservative tax plans with equivalent economic results, and it examines the economic equivalence of the various consumption tax proposals. The second is called a tax reform primer for the 2016 presidential candidates, and it walks through the various design choices that anyone developing a tax reform plan must confront. And the third is how Congress should reform business taxes, and it looks in detail at the issue of how we should tax businesses and proposes both intermediate and long-term recommendations. All 3 of these papers are available on our website. Now let me quickly introduce our speakers. First we have Dr. Dan Mitchell. He's a senior fellow at the Cato Institute. He was a senior fellow here at the Heritage Foundation before he lost his way and went to work for that other think tank. He previously worked for Senator Bob Packwood I believe before he was chairman of the Senate Finance Committee. And he's one of the nation's leading proponents of a flat tax and a tireless advocate for economic freedom. Stephen Enton is a senior fellow at the Tax Foundation. He and his colleagues at the Tax Foundation have created the best and most transparent tax model in the country. Prior to joining the Tax Foundation, he was for many years with the Institute for Research on the Economics of Taxation, working with Dr. Norman Touré. He was also Deputy Assistant Secretary for Economic Policy at the Treasury Department during the Reagan administration and worked for both the JEC and the Kemp Commission. Dr. Jason Fichtner is a Senior Research Fellow at the Mercatus Center. He is also an adjunct professor of economics at Georgetown, at Johns Hopkins School of Advanced International Studies, and the Virginia Tech Center for Public Administration and Policy. And Jason was explaining to me just before we came here that his students actually like his courses, so I'm hoping that we'll have a similar erudite presentation today. Jason served as Deputy Commissioner of Social Security and as Chief Economist and Associate Commissioner for Retirement Policy at the Social Security Administration. He also served as Senior Economist with the JEC. Steve Hayes is Chairman and President of Americans for Fair Taxation and an attorney in private practice. He sometimes calls himself a recovering tax attorney. But that means he brings to tax policy discussions a practical awareness of the real-world problems with the current tax system. I think it's fair to say that no one has done more to improve the public's understanding of the fair tax and the need for fundamental tax reform generally than Steve. Curtis Dubé is Research Fellow in Tax and Economic Policy here at the Heritage Foundation. Previously, he was a Senior Associate at PricewaterhouseCoopers, where he structured international transactions as part of the accounting firm's transfer pricing group. He also served as Senior Economist at the Tax Foundation, where he authored 3 widely recognized and cited reports: Tax Freedom Day, State Local Tax Burdens, and the State Business Tax Climate Index. Now, both Curtis and Jason are among the very best of their generation of free market tax policy experts. We're going to go in the order that people are seated at the dais, and please join me in welcoming Dan Mitchell. You can either be here or there.
Well, actually, let's just do this sitting down. I think that might make more sense than people getting up and down. Thank you, David, for introducing the panel. It's good to be back here at Heritage. I used to represent the conservative wing of the Heritage Foundation during my days, but I'm glad now that you're upholding that important role. I want to make one basic comment that I think underscores the importance of everything we're going to be talking about. And you sort of got this, of course, from Alvin, and you'll hear it later on today as well. But tax rates matter. And what really frustrates me is that politicians understand this when they want to. A lot of times we see politicians, federal, state, local level, bang their fists saying we need higher taxes on tobacco because we want people to smoke less. Now, I'm at a libertarian think tank. I don't think it's government's job to try to control our private choices. But you know what? I give those politicians an A+ for economics because they're right. The higher the tax you put on something, the less you're going to get of it. I mean, you'll also get cigarette smuggling and other negative side effects. But the fundamental economic point they're making is right. High tax rates discourage what's being taxed. My frustration is that many of those same politicians forget that lesson when it comes to taxes on work, saving, investment, risk-taking, entrepreneurship, the things that help our economy grow, the things that make us more prosperous, the things that create jobs, make us competitive. So that's really what tax reform, in my mind, I try to make it as simple as possible. That's what it's about. We want more growth and prosperity. And you heard Alvin just saying over and over again, consumption-based tax. My job on this panel is to try to explain why that's important. It's important because our current tax system treats income that you save and invest much, much worse than the income that you can consume. Think about it in this very simple fashion. You make some money, you pay tax on that money, what's left? Disposable income or after-tax income. You have 2 choices of what to do with your after-tax income. You can consume it right away, or you can consume it in the future. What's consuming in the future? It's saving and investing. Now, let's think about how the federal tax system treats those two choices. If you consume your after-tax income right away, the federal government, by and large, leaves you alone. Yeah, we have a federal excise tax on gasoline. We even have a federal excise tax on bows and arrows. But other than a few obscure things like that, there's really no federal tax on consuming your income. But what happens if you save and invest your income instead? In other words, you consume your income in the future. Well, between the capital gains tax, the corporate income tax, the double tax on dividends, and the death tax, it's possible for that single dollar of income to be taxed over and over and over again. And you don't have to be a wild-eyed supply-sider to think that if you have even low tax rates, but those low tax rates imposed multiple times, that you're going to be doing something that's going to dramatically or at least significantly affect people's decisions on whether to consume their income today or can consume their income in the future. Now, why does it matter economically? So what? Okay, so people want to consume their income faster rather than slower because saving and investing is treated harshly by the tax code. What difference does that make? Well, it makes a big difference because every single economic theory, doesn't matter, we could have a socialist up here, we could have a Marxist up here. Every single economic theory is based on the notion that you have to defer some of today's consumption to finance tomorrow's growth. You have to have what economists call capital formation. And yet, our tax system, as I just explained, mistreats and abuses the people who save and invest. Why? Well, because rich people tend to have a lot of saving and investing. That's really it. There's no underlying sensible economic theory behind it. It's simply, as Willie Sutton said about why he robbed banks, that's where the money is. Well, that's why politicians double tax and triple tax and sometimes even quadruple tax saving and investing. And let me try to sum this up with an analogy that I think perhaps makes it very, very clear. Imagine if you owned an apple orchard. You're getting into the fall. Your apples are ripe. It's time to harvest them. What's the best way to harvest those apples? Do you pick them from the tree or do you chop down the tree? Apples are income. The trees are capital. The reason we want a so-called consumption-based tax is because we don't want to mistreat capital. But to understand why it's so foolish, you don't need to think about, okay, Marxism, socialism, free market theories. Just think about it this way. If you chop down the tree, or to be technically more accurate to what the current tax system does, if you harvest apples by sawing off the branches of the tree, what does that do for your long-run prosperity, for your long-run income? You're obviously going to have fewer apples next year, so it doesn't make sense to double and triple and quadruple tax capital. In other words, on this one issue, the Marxists and the socialists are right because they happen to agree with sensible economists. You need the capital formation for long-run growth, and that's why we should have a tax system that treats all income equally, and that means no longer double taxing income that is saved and invested. You want neutrality, not only neutrality in the sense of getting rid of all the loopholes, but also neutrality in how you earn and how you spend your income. Thank you very much.
David, thank you for putting the panel together and inviting us here, and it's refreshing to see the topic coming back to life after a couple of decades of neglect in this country. I think it's critical that we worry a little bit about the tax base and the structure of the tax system and just not how much we're trying to get at any one point in time. This is not strictly about the government deficit and what's convenient when you're doing your budget resolutions in the Congress. It's about what's good for the economy and the country. I have a handout with some charts on it, which we'll put up on the Tax Foundation website later this afternoon. Dan has already done a very thorough job of going over the first chart I was going to talk to you about, where he lists 4 layers of tax on income used for saving and investment and 1 layer of tax on income used for immediate consumption. But I want to make the point that these extra layers of tax have an adverse effect on the capital formation, and the adverse effect on the capital formation has an adverse effect on employment and wages. Dr. Rabushka talked about how economists focus on efficiency. And we have been talking here now about efficiency and why it's inefficient to distort things in this way. But the reason it's so bad is that it leads to horrible inequities in the fact that you are depressing wages and taking the bottom rungs out of the economic ladder for people who don't yet have enough saving and need to rely on the saving of others to get started and have a place to work. When you cut the capital stock, you reduce the demand for labor and the productivity of labor, you reduce wages and jobs. So when people were thinking in terms of soaking the rich back in the 1940s and putting together the concept of income we now use today under the income tax, they were neglecting the adverse effect on the labor force. Now, it wasn't unknown. The godfather of the income tax, Henry Simons, one of the two leading godfathers, Haig and Simons, admitted that it would damage the economy. His current disciples don't want you to remember that, or they've forgotten it. Here's what Simons said about income taxation. Income taxation is broadly an instrument of economic control, a means of mitigating economic inequality. We shall assume that moderation of inequality is an important objective of policy and proceed to consider income taxes as devices for effecting it. The case for drastic progression in taxation must be rested on the case against inequality on the ethical or aesthetic judgment that the prevailing distribution of wealth and income reveals a degree and or kind of inequality which is distinctly evil or unlovely. Not particularly scientific. In fact, it is reasonable to expect that every gain through taxation and better distribution will be accompanied by some loss in production. Then the optimum degree of progression must involve a distinctly adverse effect upon the size of the national income. With respect to capital accumulation, the consequences are certainly to be significantly adverse. Well, he had a solution for the damage he was about to do by putting all these extra layers of tax on saving and investment. He was going to restore national saving by having the government run large perpetual budget surpluses. How often does that happen? I mean, furthermore, even if it did happen, if you're stuck in the 91% bracket, you're not going to be saving or investing anyway. So the saving that's going to go into plant and equipment spending in the United States is still not going to occur. As you buy down the national debt, people will use the reflow of their old savings as new consumption, or they'll sell assets to people abroad and let foreigners finance capital here, but our people won't. So Simons had another idea that perhaps the government would have to start allocating things to certain types of investment and pushing it that way. This was going to be the road to the government taking over far too much of the economy, and you're going down the path of Argentina and Chile under Allende and so on here. This is not a good idea. And he was very explicit about that in his big book on income taxation, but people tend to have forgotten that. Well, David's asked me to give you estimations of magnitude, but I just want to make sure you realize just how bad things are under the current system so that you can see why we're getting the results we get. Another chart I have here is a discussion of what would happen if you started saving $1,000 a year between age 20 and 70, and you had it in a pension as opposed to ordinary taxation where you were immediately taxed on your earning and on the interest as it built up. At the end of the period, you'd end up with $400,000 in the pension and only $240,000 in an ordinary savings account. You've lost 2/3 of your potential retirement income because of the double tax on saving, which was that initial double layer of tax that Dan was talking about. Now let's talk about the corporate layer that Dan mentioned. When you add the corporate tax to the tax on dividends and capital gains, you get tax rates prior to Bush's 2003 tax cuts that were about 48% on the capital gain retained earning and over 60% on the dividend payout between the corporate tax and the tax on the dividends at the upper end of the brackets. Mr. Bush reduced those tax rates to under 45% in both cases. But we've now had an increase in the individual top rate. We've had an increase in the top rate on the capital gains and dividends from 15 up to 20, and then up to 23.8 with this new tax under the Affordable Care Act. And when you add the corporate tax to that, we're at almost 50.5%. So we've taken back almost 200% of the tax cut on capital gains under Bush, and we've taken back a third of the dividend tax cut under Bush. And apparently, according to some of the people running, we'd like to go higher. Well, I'll tell you something. They're not going to get any money out of this. When the passive income tax increase on the Affordable Care Act came in, we saw a big realizations effect on capital gains and taking in advance of the tax hike. And now we're beginning to see the data from the years after it. 2013 was the first year it was effective. We're going to be seeing a crash in capital gains realizations. And the last time we tried this sort of thing, in the 1986 Act, capital gains realizations collapsed for a decade until they were lowered again under the Clinton administration, of all things, at the insistence of the Republican House. And capital gains realizations again came back up. You get no revenue from taxing something as fleeting and mobile and as time-sensitive as capital gains. And then, of course, there are the estate taxes, 40%. Now, the IRS is a bunch of kindly people who, at the instruction of the Congress, were told not to let anybody feel left out. So if you give your money to your grandchildren instead of your children, they impose two estate taxes. They take 40%, and then they take 40% of the remaining 60% in the generation skipping trust. And then, of course, if you're saving money in your retirement to add to your estate, you're paying the income tax on it. And if you're actually working somewhat after you've begun your retirement and are earning a little bit of money at that time, you have to pay the payroll tax on that as well. And then there are the state taxes. Well, the combined effects can get to be 81%, 84%. And that's at the federal level. And you can get over 90% at the state level. You're basically telling the elderly, don't bother working. We don't want you in the labor force anymore, no matter how experienced or productive you may be. Well, these are big effects on taxes. But the other big effect is on the treatment of depreciation. When you spend $1 on a machine today, that's a cost today, and it's part of your cost structure. You would think that you would define income as revenue minus the cost of earning it. That's profit. But we don't let you take the depreciation today. We make you write it off over 3 or 5 or 7 years, or a building over 39 years. The value of that write-off goes down with inflation and the time value of money. And the government's basically telling you, you're earning a profit before you're really earning a profit. And they tax you on that extra inflated profit. And that raises the cost of plant and equipment a lot. The failure to allow expensing is the biggest hit on capital in the tax system. And that's where you get the most bang for the buck if you fix it. That's why movements toward things like bonus expensing yield such a high gain for the economy in our modeling. Let me just give you an example. At 3% inflation, a 7-year asset has a write-off only worth 85 cents on the dollar. At 5% inflation, a building only has a write-off worth 30 cents on the dollar. You have to earn that additional money before that building really has any hope of paying its own way. And that results in a very big swing in the capital stock. And a big swing in the capital stock means a big swing in wages and job opportunities. So what do we get if we eliminate these 3 extra layers of tax on saving and investment and simply have a tax on consumption or the equivalent of it over time in your saving behavior? Well, it's about 12 to 13% on the GDP. We ran something where we went to full expensing, set a corporate rate at 25, but didn't tax capital gains or dividends on top of that. We have individual rates of 15 and 25. I've taken the top rates down, lifted the 10% rate up. No AMT, no PEPs, no Ps, no estate and gift tax. We get a GDP boost after all adjustments. It takes a few years, 5 to 10 years perhaps, for the capital stock to build out, of about 12.7%. GDP is over $2 trillion higher. Private business equipment and structures are up by about 39%. The wage rate's up about 10%, and hours worked about 3%. We have about 3 million additional jobs. Now, this would cost money initially on a static basis of about $400 billion a year. But by the time you've got your growth, it's under $40 billion a year. And I think you could trim a little spending by that amount. It's not too much to ask. In addition, there would be some attempt by people to report more income in the United States and less income abroad if you have a multinational corporation. And the Joint Tax Committee seems to be guesstimating things on the order of $20 billion or so a year. They don't quite explicitly state what they're doing. So you'd get a virtual balance after the growth effect from all of these tax changes. So you've got no net cost to the government over time, and you have people's incomes up about 10%, and additional jobs, so more people are working. Now, that's as close to a free lunch as you can get, and that's the damage done by the current tax system. And all the neutral taxes that David mentioned are means of getting rid of these additional 3 layers of tax. Some are collected at the business level, some are collected only at retail, some are collected partly on the business level, partly on the individual tax form. My favorite, the personal expenditure tax, is put down your income, subtract your saving, and pay tax on what's left. That way each year you sit down and fill out a form and you say, they took what? And then you don't vote for them again. Whereas the retail sales tax perhaps might be nickeled and dimed, and you might not save all your sales receipts and realize quite what has happened to you. But there are compliance and enforcement conveniences of doing it one way or the other, and we'll have to take a look at those. But of course, these are really all efforts to get away from these horrible, horrible effects of the income tax and moving to a more sensible neutral tax base. And that's where the flat tax is really the flat part. You can have one rate, you can have 2 rates, but it's the base that's flat. We're not putting one layer of tax on consumption and all these layers of tax on investment. That's the flatness that matters. And I'll take any of them that can get me there, although I have my preferences, but that's really the focus we need to have. Thank you.
So good morning. I want to thank David and Heritage Foundation for putting this together. If you haven't already realized from the first 2 speakers this morning, our current income tax system sucks. That's kind of the takeaway message. It's an economic term, yeah, it's called sucks. The United States tax code severely distorts market decisions and the allocation of resources. It impedes both economic growth and potential tax revenue. You're hearing a lot going on now because we're getting into the presidential election cycle, and there's a lot of agreement, actually, on the need for tax reform. But there's no consensus either between or within parties on some of the specific elements of reform. Even among Republican parties, there's differences on where you should focus. But luckily, policymakers need not fly blind when looking at what is a good, efficient, fair tax system. We've been talking about that this morning. So keep in mind a few things as we walk through various reform ideas. One, a tax reform or tax plan should be simple. We've been talking about this all morning already. The complexity of the tax code makes it difficult and costly to comply with. It also makes it easy to scam. Congress should make the tax code as simple and transparent as possible to increase compliance and reduce compliance costs. It should also be equitable. We've talked about the idea of equity. Policies intended to benefit or penalize select individuals or groups riddle the tax code. These policies also result in immeasurable unintended consequences. Now, fairness is subjective, but tax fairness would at least reduce the number of provisions in the tax code that favor one group, economic activity, or the other. And Dr. Rabushka talked about this morning as well. A plan should be efficient. Economists like efficiency. But because the tax code alters market decisions in areas such as work, saving, investment, and job creation, it impedes economic growth and reduces potential tax revenue. It also should be predictable. The negative effects of the current tax code result not just from what it does today, but also from what it may do in the future. Such uncertainty deters economic growth, an environment conducive to growth, and thus increasing revenues as a result of a larger economy, as Steve was talking about, requires a tax code that provides both near and long-term predictability. I've often joked, because of all these tax extenders you hear being talked about, that we now have a permanent state of temporary tax policy. That's not efficient for economic growth. Now, we've also heard this morning about how economists prefer a broad tax base with lower marginal rates, because it's the tax rates that drive the decision at the margin of what to do next. Or at the margin, do you do more work, more saving, more investment in plant, labor, equipment, or more leisure because marginal tax rates are too high? A broader base is more efficient because you're not treating some forms of income or expenses different than others, and then creating a bias. Now, a little caveat. I say generally prefer a broader tax base, but base broadening shouldn't be a trade-off for other provisions in a vain attempt to achieve revenue neutrality that would actually raise the cost of capital or undo most or all the benefits that lower marginal rates have on businesses. For example, increasing the length of depreciation schedules, that's not a good trade-off for lower rates. Personally, I think we shouldn't focus so much on revenue neutrality at all. one of the points Steve mentions is about dynamic scoring. I don't want to get into a dynamic scoring debate either, but I can tell you that what we should focus on are the right policy provisions for economic growth, competitiveness, and job creation. The tax system we have today does not do that. So we need to actually get rid of it, forget about the revenue impact, and just realize that down the road this will pay for itself. The current United States tax code severely distorts market decisions and the allocation of resources. The tax code hampers job creation, impedes both potential economic growth and potential revenue. And throughout the discussion today, also please keep in mind that from teaching what I teach my students, only people pay taxes. If you take one thing away from tax policy, corporations don't pay taxes, people pay taxes. If you tax a corporation, you're either going to have a lower rate of return for investors, you're going to have higher taxes on the products or higher prices on products, so a consumer pays for it, or you're actually going to be taxing labor, and the fact that the labor price you pay will be lower or less than it could be in the future because that money is going to taxes. So Dr. Rabushka also mentioned that many developed countries are now both reducing their corporate tax rate and restructuring their corporate tax systems to make them simpler. The United States federal government, though, appears to be taking the opposite approach. I'll note that some states throughout the United States are actually lowering their corporate tax rates and offering competitive tax packages to attract businesses, and you can see that going on in some of the southern states right now. A high corporate tax rate and numerous temporary tax revisions increase both uncertainty and cost for American business. This drives competitive profit-seeking corporations to minimize their tax exposure and defer income overseas to lower tax countries, and for some, even to reincorporate outside the U.S. Even worse, some U.S. companies take out debt in order to pay dividends to shareholders in order to maintain income overseas to avoid the high U.S. tax rate. So unless we reform our corporate tax rate by lowering the tax rate, this country actually falls further behind in global competitiveness. With a tax rate so much higher than other countries, U.S. corporations must turn to their accounting departments. We've gotten into a little discussion this earlier about hiring lawyers and accountants. Sometimes these now become profit centers. For some corporations, their tax department is the most profitable section of their business. Companies need complex financial engineering tactics to minimize revenue losses using tax code preferences. Through various transfer pricing arrangements, accountants can allocate income and capital to different countries to minimize tax liabilities and improve their competitiveness. Now, exhaustive economic research repeatedly proves the most basic effect. The more you tax capital or labor, the less you get. It also makes clear that incentives matter. Successful reform will lower current and individual corporate tax rates. Again, it's sort of a fundamental in your gut, you know it. If you tax something, you're going to get less of it. So for all the reform plans you're hearing being floated about by presidential candidates, if they're trying to raise the corporate tax rate, they obviously want less corporations. If they're actually trying to raise the capital gains rate, they must obviously want less capital and less savings. If they're trying to raise marginal tax rates, they obviously think we're working too much and we should take more time off and not work. That's sort of a basic theory of economics, and unfortunately some people don't seem to get it. We talk about special interest loopholes. The one thing I would say is we should not be raising taxes. Taxes, we should be lowering them, not raising tax rates. There are too many discussions right now about what we should do about, should we raise things, lower them? We actually aren't having a discussion we need to have, which is how do we have a better tax system that encourages jobs and growth? And how do we actually focus on the spending side? What is it do you say to the American people that says, how much taxes are you willing to pay? And then how do you actually get the best revenue system and then the best spending system that meets for your demands? Right now we basically have politicians saying, we're going to tax you here, but we're going to give you this much benefits. And so we have these giant deficits as a result. We should say, what are you willing to pay in taxes? Here's what it is. How can we live within our means? We're not having that discussion today. Just to give an idea, some economic plans have looked at that a tax increase of 1% of GDP reduces output over the next 3 years by nearly 3%. So raising taxes results in less economic output. I also want to point something, because David asked me to, about tax rates. I have a chart. I'll put it up so the C-SPAN can see it, and I'll forward it around. But basically, just realize that the excess burden of taxation varies with the square of the tax rate. So you get disproportionate beneficial economic gains from rate reductions and disproportionate harmful economic losses from raising tax rates. Economists talk about deadweight loss. If you double the tax rate, you don't just double the deadweight loss, you increase it exponentially. So it could be 3, 4, or 5 times greater. So we have to think about tax policy in the form of exponential benefits. Steve got to this when he talks about the idea of sort of some of the rate reductions and capital accumulation we can do on the tax code. It doesn't just give you a one-for-one trade-off. It's a multiplier that actually benefits greatly, and that's really important to keep in mind. I would also sort of point out that there are a lot of legislative efforts right now that are attempting to treat the symptoms and not the cause. Those that do are doomed to fail and will only exacerbate our existing problems. Policies that are trying to prevent corporate inversions by trying to penalize them will only exacerbate the problem and move corporations more so overseas. Absent sweeping corporate tax reforms, U.S. competitiveness will continue to languish, Inaction will create troublesome results, the foreign outsourcing of economic activity, a further loss of American jobs, the sale of U.S. companies to foreign multinational corporations, and a further erosion of the U.S. corporate tax base. And again, a continuation of harmful tax policies that are biasing at savings, investment, job creation, really hurt economic growth. To sum up and conclude, there is broad consensus amongst academic research as to which key policies are most likely to promote solid, sustainable economic growth and revenues, and which policies are most likely to fail. Lower rates are key. Exhaustive economic research repeatedly proves its most basic effect. Again, the more you tax capital labor, the less you get. It also makes clear incentives matter. So successful reform will always lower the corporate rate, the individual rate, on both sides. Broaden the base, eliminate loopholes. One of the keys to successful fiscal reform is to move away from a spending system that depends on an easily manipulated tax system. Tax reform should lower rates, broaden the base, and eliminate loopholes. This will increase stability and lead to greater economic growth, added employment, and perhaps most likely even increased revenues. As Steve, Dan, and Dr. Rabushka pointed out as well, we should have no double taxation. Tax income once and only once. Lastly, reduce bad incentives. Predictable tax policy is essential to long-term economic growth. No more temporary tax policy. Let's make it permanent, let's make a reform, and let's do that for the sake of the country, for economic growth, and for revenues. Thank you.
Good morning. David introduced me as a recovering tax attorney, and you probably think that I'm going to start off with a lawyer joke, and I know a lot of them. But I quit using them because I found two things to be true. One is it irritated any lawyers in the audience, and the second is everybody else thought they were true. So I am here as a proponent, and have been for 25 years, of getting rid of the income tax system we now have, both corporate and personal, the gift tax and estate tax, and going to a national retail sales tax. It started off in the 90s with the Tozan-Schaefer plan, and then we went to the fair tax, which is a 23% national retail sales tax on goods and services. And you can learn about it if you want at fairtax.org. I won't go into the mechanics. I'll be happy to answer questions as we come about. But I think we're all talking about taxing consumption. I'm talking about what I consider to be the purest way of taxing consumption, which is at the retail level. Now, there are a couple of things that have been said that I really believe are important. Most of the other, in fact, all of the other plans which involve using the income tax as a part of a way to do this require each of you in the audience as individuals to file a return. I don't know whether you remember Dick Armey used to hold up his, because I debated him, his one-page tax return, and I would hold up mine, because individuals don't have a tax return. Corporations no longer have the deadweight cost of having to comply with either a VAT, which they're doing in Europe, or the income tax. Because again, this is a tax collected by retail providers of goods and services, not the people that provide the inputs. As far as the economic growth, I think the economic growth from all of these plans are very similar. I'm not an economist, but I can read, and I've read, each of these gentlemen have written very well on the topic, and I believe there's no question we're going to have more economic growth. I think one of the issues that we probably should look at, and Dr. Rabushka brought it up because it was one of my initial problems with a consumption tax back in the 80s, and that was complexity, because in the 80s, I was, as a tax attorney, very, very, very concerned with the enormous cost to economic growth and to, frankly, the sanity of some of my clients from the tax code. And I was in favor of a flat tax, and I've stayed that way until I started coming to Washington and following what Congress did. And I began to believe that that may not be the way to go, because any kind of an income tax can always be tinkered with, and they've done it every time they've reformed it. But one of the issues back in the 80s also was compliance. And it really was a concern because obviously you've got a lot of people evading the income tax, but do you want to have a system that can be evaded even more easily? Well, times have changed. Over 90% across the country of retail sales are actually collected by, anybody want to take a guess? Less than 10% of the merchants. 90%. Think about it a minute. The Walmarts, the Targets, the Amazon.com, all of these people are collecting. For most of these, for all of them, it's an accounting situation that's most important. They're going to collect the tax. You look at the other thing, you say, well, what about the remainder of that 90%? Well, back in the 90s, Ernie Dronenberg, who was the vice chairman of the Board of Equalization in California, which is the agency that collects the tax, was telling me they were getting in the high 90s of compliance. And I thought that was interesting. Well, last Friday, I had a conversation with George Runner, who is now in the same position. He's a commissioner on the Board of Equalization, the vice chairman. And he sent me, because I asked him, I said, send me an email. I'd like to get this and also a site to a study. But he says they collect 98% of the sales tax that's owed in California. 98%. Now, do I think a retail sales tax of 23% is going to result in the same type of collection? Probably not. You're probably going to have a lot more incentive to evade. But it's still going to be much better than the income tax we presently have. And that's one of the issues that I have. When I was talking to some of the members here who were advocating, not on this panel, but members of Congress, about the flat income tax as a vehicle for getting to the consumption tax, my question was, what are you going to do about evasion? When you run a set of estimates of revenue, what is your evasion factor? Let me just ask you a quick question. How many people in the room in the last 6 months or a year have had an opportunity or know of one to get a service or a product at a substantial discount for cash? How many? Anybody? Okay, some hands are going up. Do you think that's because it's easier economically, accounting-wise? No. In most of the groups that I speak to, almost all the hands go up. And they all say no. It's because they're not paying tax. They found a way to do it. And there's a study on the underground economy by Sabula and Fagey, University of Wisconsin in Madison, where they talk about in 2000, I think it's either 10 or 11, they felt like it was as much as $600 billion being evaded. And you look at it and you say, okay, I'm going to bring the rate down. I'm going to bring it down to 15%, 20% from where it is. And that is going to make it more attractive, perhaps, for these people evading to come in, except there's one calculation left out. And that is, if you have an evasion of the income tax, you're also evading Social Security. You're also evading any state taxes. So if you bring the rate down to 20% and you're self-employed, you still got a 15.3% Social Security tax and you have whatever state tax. So you could still be paying 40%. I don't think that that's going to significantly reduce the evasion unless you get very draconian in your enforcement, and I don't believe that's even really possible today. One of the side effects of Obamacare is I know a lot of people who have left corporate employment and are now contracting because they can get much better tax benefits, which maybe that translates into exaggerating deductions, maybe it doesn't, because they can now get their insurance separately. So that's why I believe that a retail sales tax makes more sense. I think it has a lot of things, and primarily, I guess the last thing, and I used to I've said this to Curtis in a debate, and I've said it to Dan and others. If they were king and could guarantee that the flat tax alternative was going to stay in place for 20 years, I'm resigning as president and chairman, and I'm moving over to you. But I asked the question, trying not to embarrass anybody, but how many people feel that the flat tax is going to be flat in 5 years? And I almost never get a hand that goes up. And this is out in the, I'm here very little compared to my time across the country. The people just don't believe that it's going to stay flat. And I don't believe it's going to stay flat. Whereas with a retail sales tax, it's more transparent, it's much harder to adjust. Thank you very much.
Thank you all for coming. It's been a really good discussion. I think Steve and Jason and Steve and Dan have hit on all the topics we could hit on. I think we could probably sit here and talk about tax reform for the rest of the day, but I just want to hit on a few topics that have come up and a few things that are currently going on in the debate. So going back to something Dan said at the beginning, he said that there's broad acceptance that tax rates matter. I think that's largely true. But there are actually people out there who push back against that simple proposition. Go back a couple of years ago, the Congressional Research Service, which provides Congress with data and analysis of legislation, put out a report right in the middle of the 2012 election that said that tax rates don't matter. Pretty bluntly said that. And when a few of us pushed back on that to say, wait a minute, this is pretty common sense and pretty well understood that tax rates do matter, we were accused of being anti-science and not really being true to the research. Will McBride and the Tax Foundation did that. I got attacked as well. It was a kind of a bizarro world where we were stating fact and being told that wasn't necessarily true. You fast forward a couple years, last summer, Thomas Piketty puts out his book, Capital in the 21st Century. Basically says that the accumulation of capital is going to lead to the ruination of capitalism, spiraling inequality. And the way that he proposed to deal with that was to levy tax rates at astronomical rates, 80% income tax rates and above, taxing capital at over 100%. Basically said, no, the economy won't collapse because taxes don't matter. So there are people out there who will disagree with these simple propositions. And that's why it's always important that we keep making the case that tax rates do matter, they have an impact, and that it's best to keep them low. One other thing that's come up through many of the presentations is that there is no one way to get to a consumption tax. You can get there lots of different ways. So you'll see a lot, and this happens during presidential campaigns often, that there's a lot of fighting among conservatives about what is the best tax reform plan. And part of the effort that we've been doing here at Heritage is to educate conservatives and the public and lawmakers that we don't have to be fighting over so much over what the actual plan, what it looks like on the surface. I like to compare it to a software program. They all execute the same functions, but they have a different user interface, whether it's the traditional flat tax, whether it's a new flat tax, whether it's a business transfer tax, or whether it's a sales tax, or some hybrid that combines elements of all those taxes. They're all getting us to the same place. So rather than fighting over what we want the user interface or whatever we want the taxpayers to be how they're actually paying the tax, we should be saying that we're all on the same page. We want that consumption tax, we want that low rate, and we all understand the benefits that will result if we get a system like that. Lately, the tax reform debate has shifted somewhat. For a long time, the tax reform, traditional tax reform was both revenue and distributionally neutral. Go back again to 2012. Governor Romney's tax plan was revenue neutral, means it raised the same amount of revenue as the current system, and it was distribution neutral, meaning it didn't shift the tax burden up or down the income scales. Last year, then Chairman of the Ways and Means Committee, Dave Camp, had a tax reform bill that was revenue and distributionally neutral. Coming into this year, however, that constraint has changed. Senators Lee and Rubio put out a tax reform plan that was both a big tax cut, or is a big tax cut. I think we're unsure what it does to the tax distribution. I think we're we'll learn more about that as we go forward. And then Senator Paul put out a tax reform plan recently that was a big tax cut. I call these the new generation of tax reform. And they have a huge benefit. They can be much more pro-growth than traditional revenue and distribution neutral tax reform. If you look at what the Tax Foundation found, they found that Senator Lee and Rubio's tax plan would grow the economy by 15%. Chairman Camps was getting 1 or 2% growth. They can also, one of the things that happens when you do tax reform is you set winners and losers. It's just the nature of doing tax reform. When you have revenue neutral tax reform, probably going to end up with more winners than losers, but you're going to have an awful lot of losers who are going to scream really loudly. When you have a tax-cutting tax reform, you get a lot less losers. You can make a lot more people a lot better off and make it easier to pass. All that said, it does come with challenges, though. We're obviously in a tight budget environment here in Washington, and our friends on the left will immediately point out, as they always do with their reports from the Tax Policy Center, that a tax reform plan like Senators Lee and Rubio's is a great big tax cut that's going to add to the debt and have all these monumental negative economic impacts because of that. They'll also point, depending on how the tax burden is shifted, they'll point out that perhaps the rich are getting a tax cut, the middle class is paying more. That probably shouldn't work out that way if the tax reform plan is done correctly, but they're not shy about filling in details to make that fit their narrative. Again, go back to 2012, they did that to Governor Romney. All that said, these challenges are much easier to deal with if we have a dynamic score. We've gone a long way to getting dynamic scoring in Congress this year. The House is going to use dynamic scoring. The Senate, it's questionable. But if you have a dynamic score of a tax reform plan, it's a heck of a lot easier to deal with these issues. The Tax Foundation, again, found that the Lee-Rubio plan is a $1.7 trillion tax cut on a dynamic basis over 10 years. That's not that big of a tax cut. That's going to get us roughly back to the historical average over 10 years. We can certainly afford to cut taxes that much. So that dynamic scoring will go a long way to determine whether we can do a successful tax reform plan like these new generations have put together. The last time we did tax reform was 1986. And back then, individual tax reform led the charge. The code was terribly complex. No one could do their tax returns on their own. Today, it's opposite. Business taxation is leading the charge. We are so far out of step with international norms. We've become so uncompetitive that that's really the leading factor driving the desire and the debate here in Washington. And part of the reason I think that exists is because, and Dr. Rabushka got into this a little bit with the complexity, but technology has made it easier to comply with, which makes it easier for Congress to create mischief in the tax code. Right? I don't know. Not too many people do their tax returns by hand. Did anybody here do their tax return this year by hand? Actually fill them out hand by hand? Well, you're quite a trooper. So I did it once, and so I deal with taxes every day. I did it once. My wife and I had moved from one state to another. We ended up with 6 different tax returns. So I did them, filled them out all by hand, sent them in. I got all 6 back. 2 from the IRS and 2 each from each of those different states. I got them all wrong. I never tried again. TurboTax is cheap, it's easy, it's simple. I did mine on a snow day with my kids screaming in the background. I was just setting it up, thought I could just get it going while I had a few moments, and I was done before I knew it. That has taken a lot of the desire for tax return out of on the individual side. We saw this in Poland that we commissioned. There just isn't that drive. So it's going to come from the business side, which creates a new political dynamic. Right? It's a lot easier to go back to your districts if you're a member of Congress in your states and say, I want to reform the tax code because of the damage it's doing to you, and here are all the great benefits you're going to have. That's a good message to bring back. It's not such an easy message to go back and say, look, GE's just getting killed out there, and we're going to go out and we're going to make sure that GE can do better. Or we're going to make sure that GM or Microsoft or Google, whoever it is. That's a really tough sell. And I think that's part of the reason why we're having a hard time getting going. Also because it's really hard to do tax reform for corporations and leave pass-through entities alone. And of course, they're uncompetitive as well, and they need reform too. But once you're going onto the pass-through side of the business community, now you're on the individual code, and we're opening up a whole ball of wax that no one really wants to get into, given the current political debate. With that, I'll end, and I think we can take some questions and answers.
All right, we have a reasonable amount of time for questions to the panel. Please wait for the mic and give your name and institutional affiliation. Questions? Peter. Wait for the mic and so the people can hear on television and the webcast.
All right, my name is Peter Ferrara. I'm with the Heartland Institute and the National Tax Limitation Foundation. My question to you is, doesn't the Rand Paul tax reform plan address a lot of the issues you just raised?
Which ones?
Rand Paul. Well, the individual side as well as the corporate side, the pass-throughs, all of that is taken care of in one fell swoop here by the Rand Paul tax reform plan, isn't it?
Yeah, so I think that's important to point out is that, so when I talk about the difficulty in moving starting on the corporate side, I'm talking about how tax reform is usually looked at by people here in Washington, which is that we have to fit within all the boxes that, the revenue neutrality and all the things that go into the tax reform debate here in Washington. And it's more of an issue here in the next couple of years because of the dynamic with the White House and in Congress in terms of, really, the president said he's only interested in doing corporate tax reform, but never has said business tax reform. So he'll do corporations, but leave the business, the pass-throughs alone, which is very difficult to do. You have to find a way to do them together. And so we're going to be at loggerheads for the next couple of years. If you do a fundamental tax reform like Senator Paul has proposed, or Leah Rubio, or any of the tax reform plans we've talked about, yeah, you solve a lot of those issues because you don't have them. But that's really, Dr. Rabushka talked about pulling the tax code out by the roots. That's what you're doing when you're doing one of these reform plans. You're pulling out by the roots and starting from scratch.
Yeah, if you're going to fit in the box of the Washington establishment, you're never going to accomplish anything on any issue in Washington. The boxes are all designed for us to lose from the beginning. And revenue neutrality I'm opposed to revenue neutral tax reform on principle. So.
Can I say something about revenue neutrality? I agree. I'm glad that a lot of candidates are talking about tax reform plans that are also tax cuts, and I'm glad that we're also talking about dynamic scoring to try to get a more accurate assessment of what the revenue implications would be. But let's not forget, there's probably zero chance we're ever going to achieve anything on tax reform unless we also figure out some way to cap and restrain the growth of the burden of government spending. And that's why it's also encouraging to see that there's been movement, not from the White House, of course, but from Congress in terms of structural, genuine entitlement reform, because if we don't get a hold of government spending with the demographic changes, we're going to wind up like Europe, and then the only tax reform we'll get is adding a VAT on top of the current monstrosity of an income tax. So no, I don't worry about whether or not we're going to have revenue neutral tax reform in the short run, but we do need to marry our push for tax reform with push for genuine budgetary and entitlement reforms as well.
Next question. Well, let me ask a question of the panel. We have not addressed in any detail international tax questions. And the United States is the only major industrialized country that does not have a territorial system. There are a few minor or smaller countries that do. And we also, of course, our income tax is not border adjusted. Do you think that international tax considerations should be a major part of fundamental tax reform, and what do you see as being the major components of positive changes in the international area? Maybe just go down the panel.
Well, the first thing, for those that don't have the misfortune of having to follow this stuff too closely, a little bit of some definitions. Worldwide taxation basically means that the IRS taxes American companies not only on the income that they earn here in the U.S., but we also tax our companies that are earning money overseas. But of course, all those other countries where they're earning money, those other countries are imposing taxes as well. So it's a bizarre form of double taxation, and in theory, our companies get a credit for the taxes they pay to foreign governments, but it never really works out well. And you combine that with our very high corporate tax rate, it definitely puts U.S. multinationals at a disadvantage, which is why most tax reform plans, as a matter of fact, any good tax reform plan, moves to territorial taxation. And what's that? The common sense notion that you tax what's earned inside your borders. And that's it. And so you should have territorial taxation as one of the key pillars in addition to a low rate and taxing income only one time. But it's for only a narrow subset of people tend to focus on this, but it is critically important in terms of the competitiveness of your country and the companies therein.
The notion we ought to have a global tax system is that it's based on something called capital export neutrality. A company here who's going to put together a factory should not be influenced by taxes as to whether they put it here or in Canada or here or in Europe. The flaw in that argument, this leads us to say, let's tax them equally whether they're here or in Canada, and if Canada has a lower rate, we're going to put an add-on tax on it so they won't leave. The flaw in all of that is that it assumes there's a certain amount of capital being formed, that the factory is going to be created. If you overtax it, it might not be created at all. Or if it's going to be worthwhile to put a factory in Canada and we put an extra tax on it, then we won't put the factory in Canada. A French firm will come in and put the factory in Canada instead of us. The whole thing is based on the misconception that there's a fixed amount of capital and all we're deciding is where is it going to go and it might as well be here instead of there. None of that makes any sense at all. Each country will build out its capital stock until you've used all of the potential profitable opportunities in that country. If that country has a lower tax rate, there'll be more opportunities there and there'll be additional capital formed and it will be there. That doesn't mean, for example, that Ireland is stealing capital from Germany. If the Germans put the Irish tax rate on the Irish subsidiaries of the German companies, there wouldn't be any Irish subsidiaries of the German companies.
The Greeks are the ones stealing the capital from Germany.
All right. Well, anyway, so the whole thing's based on a misconception to start with. But the weirdest thing to me is if an American firm is thinking of buying another American firm for synergies and economies of scale, a French firm can come in and outbid them for the American firm because the French firm won't be paying additional French taxes on the earnings in America. It's just simply bizarre. We're treating foreigners better than we're treating ourselves. I just don't see the point in it. It doesn't get us any money. It costs us opportunities to invest abroad and then export to our foreign subsidiaries. And it makes us weaker in the world. We're a smaller share of the world economy now than we were 30 years ago. Obviously, other countries have caught up after the devastation of World War II. But we're making it worse than it has to be by shrinking our role in the world with our crazy tax system.
It's hard to follow these two. They said everything so eloquently. I'll just add a point I guess I forgot to make earlier. When we start thinking about tax reform, that of course we need to think about territoriality and lowering the rate. But always keep in mind, the ideal corporate tax rate is 0. The ideal capital gains tax rate is 0. Anything above 0 creates inefficiencies. So we looked at corporate tax reform, the lower the rate we can get, the better in general. If we had a really, really low rate, the worldwide tax in some ways wouldn't matter if we were lower than the rest of our competitors. But Dan's right, when we're looking at reform, the odds are we're probably not going to get 0. I'd like to. So we need to consider the rate and then a territorial tax system and move towards it at the same time.
Well, Jason's making a good case for the fair tax because the corporate rate is 0. And that is, in fact, what some of the economic studies show, that you are going to have an exponential attraction of capital coming in because as a recovering tax attorney, I will confess that when it was legal, I was a frequent visitor of the Bahamas and the Cayman Islands and all. And the reason was they did not have an income tax. And we set up trust and different things, and again, when it was legal, and we're able to bring tax payments very, very low because of that, because capital is calculating its return also based on what it can take home after taxes. And if you have no tax on savings and investment or on the corporation itself, you're going to have a lot more people looking favorably at the United States to invest capital. The second thing is border adjustability, and the economist here should be explaining this, not me, but basically what we do not have under the income tax presently, even though we've tried with GATT and failed, is any way to make the type of adjustments that our trading partners do, because when they export goods from countries that have value-added or other consumption taxes, they rebate those taxes at the border, they come over here, and they're effectively not taxed. It's a very, very, very low rate of tax because we don't tax on the imports. we tax on any profits made from selling the imports. What we're talking about with the fair tax and with the other types of corporate taxes that are being proposed here is that there would not be the tax carried, in other words, the cost of government carried when we go overseas, and conversely, when they send products over here, they would be subject to the same tax that our products are. So I think it's very, very important to have border adjustability. And it's very, very important to be in the forefront of attracting capital from not only here, but some of that assumed $15 to $20 trillion that's offshore now that really isn't in any country that's looking for places to go.
Yeah, I think that hits on all the points. Any tax reform plan that establishes a consumption tax base should be territorial, should only tax income earned here in the U.S. One thing I want to add about the misconception of a worldwide system, part of the fallacy is that we have to have a worldwide system because businesses create operations overseas that they would have created here. That's not true. Businesses open up operations abroad to chase new opportunities and new markets and new demand abroad. And we want our businesses to be chasing new customers. We want them to be selling more. When a company is expanding overseas, it's also expanding back here. The economic literature is very clear on that. A company gets more efficient, it creates new synergies, it grows, it creates jobs here at home.
David, can I actually just add something real quick?
Yep.
Dr. Rabushka mentioned this earlier about one of the biggest selling economics books now, the modern era, is Thomas Piketty's book. And I think there's been a lot of discussion, but some of the lessons haven't been learned correctly from that. So just a reminder, Piketty's basic argument is R was greater than G, meaning the rate of return to capital was greater than the growth in the economy, and that those that invested in basically the market did better than those that were just in wages in the economy, and that was creating an income inequality. That led some on the left to say, see, we were right, we need to tax capital and tax the rich that aren't any rich anymore. The rest of us looked at it and said, well, wait a minute, if you're trying to increase G, why don't you increase it through tax reform, get rid of government regulations, and reduce the taxes on labor so more folks get a return on labor? The second lesson is, if R really is greater than G, why aren't we doing our best to make it so that more people have access to R with better savings incentives, retirement savings plans? So it's interesting how, even if you take Piketty's sort of research at face value, and some folks have said there's problems with it, but if R really is greater than G, then we need to change our policies, including tax reform, to bring up G and give more people access to R. Steve?
There are problems with it.
I know.
R is greater than G if you reinvest all of it. And you get the wealth inequality, but you don't. You live off, when you retire, you live off some of the returns on your old capital. So the R isn't being reinvested, so the wealth inequality isn't rising. The poor guy simply didn't understand that some people in retirement have to draw down on their dividends and they can't reinvest all of them. And that just completely trashed his entire argument. Mike Schuyler and our staff ran the Piketty plan through our model, and it crashed GDP by over 15%, and that included a drop in labor income of over 15%. And that was on all levels of wages and labor, low-income people, middle-income people, high-income people. The plan made no sense at all. I want to emphasize one thing, though. All of these consumption-based or income minus investment-based plans are, in effect, helping with the capital formation here. They're all, in a sense, either explicitly or implicitly border adjustable to the same degree, although one is in the law and the other one simply happens because if you're saving it, you're not consuming it, and if you are consuming it, it falls on the import as well as the export. They're all better than current law on our international trade in and about the same way. So that is something. The international benefits of doing this perhaps are overstated from just going to a flat base. It's the territoriality that gives you the additional kick of not penalizing American firms that are trying to invest abroad. That's kind of a different question. Territorial is a little bit different from the concept of a neutral or flat tax. But they're both very important. And I'll tell you this, the business community is not waiting for the Congress to get off the dime here. They are investing more and more abroad, and if necessary, spinning off their foreign subsidiaries and or arranging for their headquarters to move overseas. This is do-it-yourself tax reform. They're not going to wait for you. They can't wait for you. Burger King is a very funny case. Burger King had some foreign operation didn't want to have to manage, so it spun off Tim Hortons or Tom Hortons? Tim Hortons. And Tim Hortons got bought out by another Canadian firm and grew, and then it turned around and bought Burger King. Now, this was not some vicious plot to get around our international tax rules. It just happened in terms of economic growth, and the companies were familiar with each other, and they went ahead and did it. It's just one of the funniest cases out there, but this is going to happen more and more and more as time goes on if Congress doesn't get off the dime.
We need to wrap up this panel. Our next panelists are here. So please join me in thanking our 5 panelists.
Now for our last panel of the day, I'd like to introduce my colleague, Steve Moore. Steve is the Distinguished Visiting Fellow in the Project for Economic Growth at the Heritage Foundation's Institute for Economic Freedom and Opportunity. In addition to his role at the Heritage Foundation, he is a contributor to the Wall Street Journal and Fox News. Mr. Moore has served as founder and president of the Club for Growth, a senior economist at the Joint Economic Committee under former Chairman Dick Armey of Texas, the Grover M. Herman Fellow in Budgetary Affairs at the Heritage Foundation, a special consultant to the National Economic Commission, and research director of President Reagan's Commission on Privatization. He's a graduate of the University of Illinois and holds a master's degree in economics from George Mason University. And in 2010, he was awarded the University of Illinois Alumni of the Year. Please join me in welcoming Steve.
Well, good afternoon, folks. Thank you for being here today. We have sort of bookends. We've got the 2 leading intellectual advocates of the flat tax here today, starting with Alvin Rabushka and ending with Arthur Laffer. Both of them have probably been the 2 most influential people in promoting this idea over the last 25 or 30 years. So it's a pleasure to have Art Laffer here. You all know Art Laffer from being the kind of intellectual architect of Reaganomics and the man who turned Ronald Reagan and Jack Kemp onto supply-side economics. By the way, there's a great new book out that I've been reading this weekend about Jack Kemp by Morton Kondracki and Fred Barnes, and it tells the whole story of how Arthur Laffer and Jude Wanniski and other kind of intellectual leaders of that long, long, long ago era really turned around the country in terms of promoting their ideas and getting Ronald Reagan to sign on to these ideas and a movement that not just only changed the United States, but really changed the world economy. So to that, we owe Arthur Laffer a great debt of gratitude. He is the author of many, many books, including, most recently, an inquiry into the nature and cause of the wealth of states that I wrote with Arthur, and we have 2 other authors, Rex Sinkefeld and Travis Brown, which is about why some states are growing so much faster than others. So without further ado, I want to introduce my good friend, Arthur Laffer.
Are you going to sit right up there, Steve? So I could just sort of... That's impressive, don't you think? Steve sitting there. I can look right at the back of his head the whole time. See, how are you going to do when I do a facial thing? How are you going to be able to recognize my facial move? I go like this, you know. I'm going to have a little fun with you today, if that's all right, and go through some of this. Sean, how are you? Good to see you, sir. Howard, golly, what? How many of these people? I thought all of you were dead by now. Jeez, I mean, one of the real pleasures when you get to be my age of 75 is that all your enemies have died. But that's, you know, Hillary's still around, I guess, so as long as that's happening. What I want to do is just start with really simply incentives. There are 2 types of incentives in this world. There are positive incentives and there are negative incentives. By way of illustration, the example I like to use is if you beat a dog, you know where the dog won't be, but you have no idea where the dog will be. It'll take off like mad, but you don't have any idea in what direction. Positive incentive, those are negative incentives. The stove doesn't care where your hand is as long as it's not on it. Okay? But positive incentives tell you what to do. Negative incentives tell you what not to do. Positive incentives tell you what to do. If you feed a dog, you know exactly where the dog will be when it comes to food time, feeding time. You know exactly. So you got to look at the world in terms of these incentives. And when you look at taxes, which I'm going to talk to you about here, taxes are a negative incentive. They tell people what not to do. do not report taxable income. They don't care how you don't report taxable income. They care that you don't report taxable income. You can use evasion, avoidance, underground economy, moving to a different location, or going out of business. All it is a negative system. So you got to understand taxes are a negative system. And when you look at it, you understand it intuitively. I mean, why do we fine speeders on a freeway? To get them to stop speeding. Why do you tax cigarettes? To get people to stop smoking. Why do you tax income? You don't do it to get people to earn less income. So when you look at a tax system, what you want to make sure you do is you recognize the purpose, and the purpose at hand is to raise revenues. So what you want to do to avoid the damage is you want to collect your taxes in the least damaging fashion, and obviously spend your proceeds in the most positive fashion. But you've got to understand negative and positive. For example, you never want to mix a positive in with a negative. I mean, you just don't. You don't want to have a negative system and try to put a child tax credit's a perfect example of mixing a positive with a negative system. You should never use a child tax credit. If you want to reward people for having children, which is perfectly fine if you like to do that. I have 6, Steve. So I'm all for rewarding people who have lots of kids. But write them a check. Don't give them a tax credit. Write them a check. There are lots of people who don't file tax returns, who do have children, and you get all sorts of distortions in the system. But let me, if I can, go through a couple of these with you, because it's really important here. Why would you ever want to cut taxes on people with high income instead of cutting tax rates with people with low income? Why would you ever want to do that? I mean, what on earth would generate someone to cut the highest tax rates and not use that to cut the lowest tax rates? And let me go through with you just a couple of things on why you would want to do that. The first thing is if you're looking at a cost-benefit analysis, and I'm going to use the example of John F. Kennedy, if I can. And John F. Kennedy in the 1960s, in 63, I think it was passed in 63 or 64, the tax bill, he cut the highest marginal income tax rate from 91% to 70%, and cut the lowest tax rate from 20% to 14%. All of you with me? If you look at it in percentage terms, by cutting the highest tax rate from 91 to 70, that's 21 percentage points divided by 91. That's a 23% cut in the highest tax rate. And by cutting the lowest rate from 20 to 14, that's a 6 percentage point cut out of a base of 20. That's a 30% cut in the lowest tax rate. All together with me? If you look at it, Kennedy cut the highest tax rate from 91 to 70, 23% cut, and the lowest rate from 20 to 14, that's a 30% cut. And if taxes were all that mattered, you'd be perfectly correct in saying that he cut the lowest tax rates by more than the highest. But remember, taxes are not the issue. People don't work to pay taxes. People work to get what they can after tax. It's that very personal and very private incentive that motivates them, which is not exactly taxes. In fact, it's the earnings rate, it's the incentive rate that really matters. Let me take you through the incentive rate. A person in the highest tax bracket, before Kennedy cut that tax rate from 91 to 70, if that person earned $1, they had to pay 91 cents in taxes, and their after-tax incentive for earning that $1 was 9 cents. Altogether, in the lowest bracket, a guy earned $1, paid 20 cents in taxes, and his or her incentive was 80 cents for earning that $1. Altogether, after the tax cut, by cutting the highest rate from 91 to 70, the incentive, the after-tax incentive rate for the person in the highest bracket went from 9 cents on the dollar to 30 cents on the dollar. Now, after the Kennedy tax cuts, they earn $1, they pay 70 cents in taxes, and they're allowed to keep 30 cents. If you look at it from the standpoint of incentives, that's a 233% increase in incentives for a 23% cut in tax rates. That's a 1 to 10 cost-benefit ratio. Looking at static revenue loss to an incentive effect, you get a 1 to 10 cost-benefit ratio. You follow me on that. If you go to the lowest rate, before the tax cut, the guy earned $1, paid 20 cents in taxes. His incentive or her incentive was 80 cents on the dollar. After the tax cut, going down to 86 cents on the dollar, that was the incentive. That is a 7.5% increase in incentives for that person. For a 30% cut in rates, that's a 4 to 1 cost-benefit ratio. Whenever you cut tax rates, the higher the tax rates are, the greater is the percentage increase in after-tax incentives for doing the work for every given static dollar of loss. That is one of the key reasons why you want to cut the highest tax rates the most, because you get the greatest trade-off between cost and benefits from that. Are all of you following me on this? Please do. I hope you do. Second thing I want to go through is in taxes, marginal tax rates are the key, or if I should say it to correct myself, marginal incentive rates are the key for the tax cuts. You always want to look at incentive rates and on the margin. When you look at a tax return in the U.S., every single taxpayer pays the lowest tax rate. Every single one of the taxpayers pays the lowest rates. And as you go up in the brackets, fewer and fewer people pay the higher tax rates until you get to the highest tax bracket. If you're at the highest tax bracket, everyone in that tax bracket is paying that tax rate on the margin. When you look at the actual tax brackets and the filing of tax returns, and I don't remember what year it is, but less than 2% of all taxpayers actually pay the lowest tax rate as a marginal tax rate. All the rest of the tax cuts are inframarginal. If you cut the lowest tax rate, you will have an incentive effect to change the marginal rates of substitution between labor and leisure. The only one where you'll have the substitution effects operating are on a very small percentage of those people in that lowest tax bracket. Again, so the higher you go up, the more effect you have of cutting the marginal rates and changing the marginal rate of substitution between labor and leisure. Another reason for cutting the highest tax rate. The last one I want to go through here with you, which I think is very important as well, is rich people are different than poor people. They've got money. They've got the means to do things that poor people don't have. And in fact, rich people have also the ways to do things that poor people don't have. They have both the ways and the means to change their tax codes. They can hire lawyers, accountants, deferred income specialists, favor grabbers, congressmen, senators. I mean, when you see a group of people hanging with the president, don't for a moment think that this is a group of street people trying to explain to the president what it's like being poor. Now, they're switching positions between Goldman Sachs and the White House. Rich people have the ways of changing. I mean, I moved from California, Rancho Santa Fe, to Nashville, Tennessee, purely and simply for the income tax. I bought my house in Tennessee with my first year's tax savings. I had to hang up pictures. I don't know if I've told you this, but I had to do watercolors all over the house and beach scenes and bikini girls and palm trees and all that stuff all over the house for the first couple. I had salt sprays in every room and big sun lamps and all that and Beach Boy music in the background, but I got over it. After 3 years, the statute of limitations was gone and I could go back and visit. But you know, rich people can change the timing of their income. IRAs, KIOs, 401ks, all this sort of stuff. They can change the location of their income. They can change the composition of their income. I mean, they can go from unrealized capital gains to income. I mean, they can change the volume of their income. People who are high income have a far more elastic, and forgive me for, I don't know how many of you are economists, a far more elastic supply of taxable income to the system than lower income people. The reason you cut tax rates on the highest group is not because you love rich people, although there's nothing wrong with rich people, as long as they help me as long as I need. And if the Heritage Foundation isn't the place for that, Steve, I don't know what is. But if you look at it's because you get more bang for the buck. Number one, the cost-benefit ratio is lower for the highest brackets because the incentive effects are much greater the higher tax rates are per dollar of static revenue loss. In the highest brackets, you find a lot higher brackets, you find a lot more people on the margin than you do in the lowest brackets. And thirdly, you find in the highest brackets, people have a lot more ways of changing their income and the elasticity of supply. That's why you want to cut. Now, what you want to do with this is you can see that the broader the base, it leads you to a flat tax going through this logic. I want to talk to you about one other one, too, is redistribution. And it's a really important theorem. It taxes and government, but redistribution, and this is all Piketty stuff, if you forgive me. But redistribution is whenever you take from someone who has a little more and give to someone who has a little bit less. You with me? That's the sort of quintessential definition of redistribution. You know, if you take from someone who has a little bit more, you've reduced their incentives to earn income, and they'll produce a little bit less. If you give to someone who has a little bit less, they all of a sudden have an alternative source of income other than working, and they too will work a little bit less. The theorem here is really explicit and unambiguous. Whenever you redistribute income, you reduce total income. Whenever you do. Redistribution always comes at a cost of lowering total income, period. That's math. It's not economics. It's math. When you take from someone who has more, they have an incentive to produce less. You give to someone who has less, they also have an incentive to produce less, and both parties will produce less. The theorem is really simple. Whenever you redistribute income, you always will get less income. The more you redistribute, the lower income will fall. And in the extreme, if you redistribute income completely and totally, you will end up with zero income totally. And you can see that. If you did redistribute income totally, where everyone who earned above the average income, that person was taxed 100% of the excess, and anyone who earned below the average income, they were subsidized up to the average income. If you actually did that, everyone would end up with the same amount of income. It'd be exactly equal. Now, if I actually did tax everyone who made above the average income 100% of the excess, and I did subsidize everyone below the average income up to the average income, I think we can all stipulate today, Counselor, that everyone's income will be equal at zero. Just remember, these are the theorems when you go into policies. Why you want a flat tax and why you want a flat tax to be comprehensive is because except for the speeding and the cigarettes, i.e., those taxes that you are imposing on a system to change people's behavior. The joke I like to use is we Americans, I guess, don't like drunk people smoking while we shoot each other. Except for sin taxes, which are there to change behavior. What you want to do is do the least damage to the system in collecting the requisite revenues to run the government. That's what you want to do. You want to collect your taxes in the least damaging fashion and spend the money in the most positive fashion. And when the last dollar of taxes collected is a little bitty less painful than the last dollars of money spent is beneficial, you stop already. That's where government stops spending. That's the correct and optimal conditions there. So what you want to do on these taxes, if you really want to get to where you have the least damage done by collecting, unless you know the net supply elasticities of every factor in the world, which obviously none of us does. If you don't, the best analysis is to assume all factors have the same elasticity. So what you want to do is have the lowest possible tax rate on the broadest possible tax base to provide people with the least incentives to evade, avoid, or otherwise not report taxable income, and give them the least places to which they can place their income and be exempt from taxation. You want the lowest possible rate on the broadest possible base for a tax system. You all there? I mean, obviously the rest of the program should be, you want spending restraint. Government spending is taxation. Government doesn't create resources, government redistributes resources. Whenever the government bails someone out of trouble, they're putting someone else into trouble. Believe me when I tell you. Sound money, you need sound money, and I'm not going to go through all of it, but you need sound money. You need free trade. I mean, just for you guys here, because Heritage needs this lecture. Free trade is wonderful. There are some things America produces better than foreigners. There are some things foreigners produce better than Americans. We and they would be foolish in the extreme if we didn't sell them those goods we make better than they do. In exchange for those goods they make better than we do. It's a win-win. It's called comparative advantage. Gains from trade. David Ricardo, hello. That's what it is. China is not our enemy. China's our best friend. Without China, there is no Walmart. And without Walmart, there is no middle class or lower class prosperity. The issue is not China's our enemy. China's our best friend. You know, sanctions on countries don't work. Sanctions on North Korea, you see how they've caused them to see the light? Oh my God, America, you're so right. We've been sanctioned for only 65 years now. We now see the light of free market, pro-growth, democratic economic capitalism. No. We have got a population there that's hostilized, anti-American forever and ever. Amen. When did we start sanctions on Cuba? Well, I'll not go through this. Sanctions are the antithesis of how to win friends and influence people. Free trade. And lastly, regulations. But I want to stay with taxes here. Taxes on this. A low-rate, broad-based, flat tax. And I'm going to stay with you on this one because most people think that it doesn't make sense politically. I did a proposal long time ago called the Complete Flat Tax, which got rid of all federal taxes. All of them. It got rid of the personal income tax, gone. Corporate tax, gone. All payroll taxes, both employer and employee, gone. Excise taxes, gone. Medicare, Medicaid taxes, gone. Capital gains taxes, unearned income taxes, every one of those gone. Tariffs, all of them gone. Got rid of all federal taxes, with the single exception of sin taxes left them, and they're not a very large portion of total tax revenues. If you replace static revenue, no Laffer curve effect on this thing, static revenue of full employment, all federal taxes, with two flat rate taxes, one on business net sales and one on personal unadjusted gross income, no deductions, no exemptions, no exclusions, you could match all federal taxes today with a tax rate of about 12% on each. Can any of you imagine if we had no federal taxes in this country, except for two flat rates, one on business net sales and one on personal unadjusted income at 12%, can any of you imagine what this country would look like? I mean, we'd be selling cars into central China. We'd be the boom of all the centuries. For those of you, what I am doing is taxing GDP once when it's spent and GDP once when it's earned. Obviously, the reason that doesn't come out to 20% is because there are certain items like imputed rental value of owner-occupied homes and some of the corporate profits from government corporations and stuff. But that's the way you want to go your taxes. Now, that tax, I was able to con governor of California back in 1992 to do this, Jerry Brown. Jerry Brown did that. Jerry Brown in a Democratic primary, now ran on this proposal. Now he raised it by 1% because he wanted a little bit more revenue. I guess you can tell just looking at him, he likes to spend. But he raised it one. So we went on a flat rate tax of 13% on business net sales and on personal unadjusted gross income. He went from 8th in the race in the Democratic primary to 2nd. I think we lost in Wisconsin by 1 vote or something. It was really close in Wisconsin. Going into New York, Jerry Brown had Bill Clinton in his crosshairs. This is Democratic primary now, all the lefty-wefties and all the weirdo freaks and all that. He was going into New York. We were catching up in the polls. We almost had him. I mean, and 3 weeks out of the New York primary, Jerry announces his running mate is Jesse Jackson. Needless to say, we didn't win. But Jerry Brown literally came in 2nd in the Democratic primary in 1992, the first major presidential candidate to run on getting rid of the progressive income tax in history. Let me take you through one more where it shows its popularity. 1986 Tax Act. Any of you know the 86 Tax Act? None of you are old enough to remember it. You may be. Barely. I love picking out those. Howard, you do? Oh, there we go. Okay. I mean, the 86 Tax Act, what we did was we cut the highest tax rate from 50% and dropped it to 28% on the fat cat richies. all the little tummy wummies, you know. And then, in case we missed a couple of fat cat richies, we cut the corporate rate from 46 to 34%, which, by the way, at that time, put us the lowest in the OECD, the lowest corporate tax rate in the OECD at that time. 35%, now we're the highest. So Steve Moore has documented the revolution that went across the world on tax cuts. Cut the highest rate on income from 50 to 28, cut the lowest rate at corporate rate from 46 to 34, and just to make sure we didn't miss anyone and didn't show our disdain for the poor, the minorities, the disenfranchised, just to make sure. We raised the lowest rate. That'll teach you to be poor. We raised the lowest rate from 12.5% to 15%. Now, as you all know, we weren't trying to redistribute income the reverse way. What we were trying to do was move towards a flat tax. We got rid of 14 tax brackets. We made it 2 tax brackets, 15 and 28. We got rid of deductions, exemptions, and exclusions, such that it came out exactly static revenue neutral. Exactly. Reagan said, if it raises $100, I'm going to veto it. And if it costs $100, I'm going to veto it. This is about the constellation of tax rates, not about a tax cut or a tax increase. Period. Can any of you imagine that bill today in Congress? I mean, I don't think there's a Republican who'd vote for that today, let alone any. The vote in 1986, the vote in the Senate in 1986 was 97 to 3. 3 senators voted against that bill. Simon, with the little bow tie from your state, Illinois, Steve. Melchior, I think, Melchior was from Maryland, I think. And Levin, who was just retired from the Senate from Michigan. Alan Cranston, Mr. Lefty Wefty himself, he voted for it. My next door neighbor and dear friend, I see a lot of, Al Gore, he voted for it. He told me 6 months ago it was the best bill he ever voted for, led to 20 years of prosperity. Tall and pink, what's his name, Bill Bradley, he voted for it. Mr. Death Tax himself, Howard Metzenbaum, he voted for it. What's his name from Delaware, Joe Biden, he voted for it. Chris Dodd voted for it. Teddy Kennedy voted for God's sakes. In the House, back then, Barbara Boxer voted for it. Harry Reid voted for it. Little Dickie Durbin, he voted for it. Charlie Rangel voted for it. Chuck Schumer voted for it. Why did they vote for it? Why? Because it's the right thing to do. And it was the right thing to do, and they voted for it. And believe me, when you name the North Star, when you describe the tax codes correctly, and you believe in what you're doing, you can win that really easily. We are at a stage in our history where we need to redefine the North Star, go through the tax codes correctly. We need a low-rate, broad-based, flat tax, conceptually clean. There's plenty of time to compromise in the middle of the legislative process. You don't have to compromise before you've even started. Describe the North Star and let the race be run on the North Star. And then when you get to the legislative process, you can compromise. You know, there are a couple of others I'd love to just quickly. I think we should have 1 year, every other year we should only be allowed to repeal legislation. I don't know if you like that one. I also think congressmen and senators ought to be put on commission. I have no problem with them making lots of money as long as I do too. So I would put them in. What I would do with every congressman and senator the day he or she took office, I would give them a shadow portfolio of $5 million. I'd allow them to keep all the capital gains tax-free and hold them personally liable for all the capital losses. Believe me, they'd never vote the way they vote today. And with that, Steve, I will stop. And have I done enough damage? Thank you.
I'm just going to make a couple comments about what you said, Arthur, and then we'll get into the discussion. I was asked to talk a little bit about the politics of the flat tax. Arthur and the speakers you've heard earlier this morning talked about the economic case for this, but the question, of course, arises: why is it that We've been talking about this issue for at least 25, 30 years. 20 years ago, Steve Forbes ran for president on the flat tax, and he did well with it, but we're not that much closer to a flat tax today than we were when Steve Forbes first introduced this idea. Now, you've heard today all of the economic arguments in terms of why this would dramatically improve the economy and create jobs, but I wanted to just make a few points about how we sell this issue, and then Arthur and I will engage in a little bit of conversation on this. As most of you probably know, Arthur and I spent many months with Rand Paul, helping him develop a flat tax proposal, and he's come up with something very similar to what Arthur just described, the complete flat tax. It's not entirely the same, Arthur, but it has a lot of the same characteristics. It's a 14.5% to 15% a flat rate income tax. It has, it's the 15% on the personal income tax and on the business side, very similar to what Arthur just described. It's essentially a business net sales tax, and it has gotten an enormous amount of attention already. It's only been out there for about 3 or 4 weeks, but he's had 4 million hits on his website, and it's just a deluge. They shut down the website. It got so many hits the first week the plan came out. We found that even IRS agents were interested in this plan because they saw the benefits of it. And yet, even at the polling that we've been doing at Heritage on this concept of the flat tax as a concept is not especially popular. A lot of people like it, but a lot of people don't like it. And the question is, what do we do? What are some of the arguments we should make in favor of this? And I just wanted to mention 2 or 3. One is the obvious one, which is the international competitiveness aspect of this. And the idea of the United States having a 15% tax rate when the rest of the world is at 35 or 40% would give America an obvious huge competitive advantage in terms of companies locating here rather than locating abroad. And one of the ways that I like to try to emphasize the importance of this, because a lot of people on the other side of the aisle don't believe that these tax rates matter. Arthur, they don't believe a word that you say. They don't think that tax rates have much of an impact on where people go and where capital goes and where businesses flow. And many of you know, just about a week and a half ago, I was in Las Vegas debating Paul Krugman, who's probably the most influential left-wing economist in the country, and he writes for the New York Times twice a week. And when it comes to politics, it's hard to point to anyone who has more impact on the way that Democrats think than Paul Krugman. And what was interesting, we got into this big debate about states. And as I mentioned, Arthur and I both have this book out about the wealth of states, about the fact that people are moving from high-tax states to low-tax states. And the evidence is just overwhelming that this is happening. I'm not going to go through all the arguments of it, but I just showed Paul Krugman this chart, and many of you have seen it, that shows that Texas and Florida have created over the last 20 years. By the way, Texas and Florida have no income tax versus California and New York, where they have a 13% income tax, as Arthur just described. And what we found is that for every job that has been created over the last 20 years in New York and California, 3 to 4 jobs have been created in Texas and Florida. And I confronted Paul Krugman with this data about, how do you explain this, Paul Krugman, that so many of these jobs are flowing from states that did exactly what you told them to do, and they're going to states that did exactly what Arthur Laffer told them to do. And what his response was, they were moving because of air conditioning. Now, that's a crazy thing to say, and by the way, with everything Krugman says, there's always kernels of truth. So it is true, all things equal, people do move to warmer states. But the point I'm making here is that it is irrefutable that tax rates matter on the state level. There's no question about it that there's a massive flow. We estimate about 1,000 people a day are moving from these high-tax to low-tax states. My point is, if people would move from one state to another because of a, say, 13 percentage point differential in the tax rate, they're going to move substantially across. Capital is going to move across borders if you have a 20 or 30 point advantage on tax rates that we would have if we had the flat tax. That's number one. Number two, maybe the most important argument, in my opinion, right now in terms of convincing the American people about why we need a radical change in the tax system, and that's either the flat tax or what Steve Hayes talked about, a national sales tax. The major, I think, selling point of this isn't even an economics point. It is a point about anti-corruption in Washington. And if you look at the polling, if you look at what's happened with Donald Trump, I am not by any means a supporter of Donald Trump, and I thought what he said this weekend about John McCain was despicable. But there's no question about it that what Donald Trump has tapped into is this idea that Washington is corrupt, that it is incompetent, and there's too much cronyism, and that we need a kind of to take power away from Washington. That's what Donald Trump is talking about. And if you want to do that, what is the kind of epicenter of the power structure in Washington? It is the tax code. It is that members of Congress buy and sell tax favors every single day. And the point I think we need to make over and over and over again is that if you wipe out all of these special preferences, all these carve-outs, all these special interest provisions that keep K Street in business, you're going to take power away from Washington, right? And you're going to replace it to the people. And this is a kind of power to the people initiative that I think we don't talk enough about, that no longer would people have, these politicians and the lobbyists have the power to influence where money flows just based on the tax code. And a final point I'll make about this that I think we underestimate, but is a really important one in terms of selling this concept to the American people, is that you mentioned, Arthur, the corporate tax, which is an abomination. I don't think you could probably come up with a worse tax. Maybe you could correct me if I'm wrong. I can't think of a worse tax than our corporate income tax. We're basically taxing our producers, and we're not taxing producers that produce things and bring them into the United States. The thing that's an interesting element to the flat tax, the complete flat tax that Arthur and I put together, that I'd like you all to think about, is that when you have, let's say, a 15% complete flat tax, what this plan is, it's a GATT legal 15% tariff on anything that's brought into the United States. So in other words, instead of taxing what we produce, we're now going to tax people on what they consume here in the United States. And that's enormous. I believe we can go to blue-collar workers across America and say, look, this is what you've always wanted. You wanted a tax system that gives America a fair advantage. And that's what this plan does in spades. And I think that is a very, very powerful message to blue-collar workers across America who make things, who basically look at things coming in from China or things coming in from Japan or other countries and say, wait a minute, we want to at least compete on an equal basis. And this plan that we're talking about would do that. I do think that when you look back at what happened in 1986, it was kind of a miracle. All the stars were aligned. And if you look at America in 2015, it just feels to me that the American people feel that the tax system is so corrupt right now and is so filled with special interest provisions that don't benefit them but benefit, the corporation down the street, that the time could not possibly be more right with this. And so let me start with a question for you, Arthur, about this. First of all, do you agree with my assessment? And second of all, the depressing part about what's happening is that on the Democratic side of the aisle, we have a senator from the state of Vermont, Bernie Sanders, who's basically been giving speeches around the country saying we should go back to 50 or 60 or 70 or 80 or even 90% tax rates. And he says the economy performed very well back then when we had tax rates as high as 70, 80, 90%. We can have a strong economy with tax rates that high again. How would you advise people to respond to that argument? And by the way, he's climbing in the polls with this very populist argument.
Let me just say first, I do agree, Steve, with what you said on this one. And Bernie Sanders is, they had high tax rates and the economy prospered. My suggestion to Bernie Sanders to prove his point was we should raise tax rates to almost 100%. Then drop them down to 70% and watch how the economy improves there. If you look at the history of the U.S. in the post-World War II era, it's amazing. Highest marginal income tax rates at the end of World War II, 92.5%. I mean, think about it for a split second. Here you have the U.S. where the House has to pass the bill, the Senate has to pass it, and the President has to sign it. And the highest marginal income tax rate at that place was 92.5%. I mean, think about the debate in Congress back then with the lefties and the righties. The righties going, okay, I'm willing to go 92.5%. I am. But 95%, that's gouging. And the lefty says, yeah, but 90% is a giveaway to the fat cat rich. I mean, if you look at it, it went from 92, then 92.5, then Harry Truman cut it to 91, Jack Kennedy cut it to 90, then we had it cut down finally to 28%. If you look at the trend in the U.S. and the world, it is moving away from this, and we have a different world today. If you look at union representation back then today, I mean, we are becoming so much more of a free market, free enterprise world. You know, to think that there will be any major change in that trend, I think is a real mistake. What I think is going to happen is that in 2016, we're going to win the election in a landslide. And by the way, it may well be a Democrat. You know, this is not Republican or Democrat. It's not liberal or conservative. It's not left wing. It's right wing. It's basic economics. Jack Kennedy did it. Bill Clinton was great. Ronald Reagan was terrific. I mean, it's bipartisan, both ignorance and blessings.
So some of your critics say that the economy performed obviously very well in the Clinton years. And that
Did really well.
Clinton raised tax rates, so this is counter to your theory. So
Clinton didn't raise tax rates. I mean, come on. If you look at him, the first thing he did was he pushed NAFTA through Congress against his own party, against the unions. I mean, seriously, you got to take your hat off and say, congratulations, Mr. President, that was a wonderful thing. He got rid of the retirement test on Social Security. It used to be when you hit the age 65 to 72, every dollar of income you earned, you lost 50 cents in Social Security benefits. He got rid of the retirement test on Social Security. Massive tax cuts on elderly workers. He signed into law welfare reform, the idea that you actually have to look for a job to get welfare. Oh my God, how unfair. He had the biggest capital gains tax cut in our nation's history. I mean, think about what he did. He dropped the highest rate, I think, from 28 to 20. But the thing that he really did was he exempted all owner-occupied homes from capital gains taxation. That is enormous, the size of that tax cut on that. But just to save the best for last, Bill Clinton, as President of the United States, cut government spending as a share of GDP every single year for 8 years running. He cut it more than the next 4 peacetime presidents combined, the best peacetime presidents. So when you look at Clinton, to say that he raised tax rates because he raised the 2 highest tax brackets, which he did do, and say that defines his presidency, that's nonsense. That's just not correct. He was a great, great president on economics, and his biggest mistake was allowing the personal income tax rate to go up. But that by no means offset all the wonderful things he did in economics.
So how would you respond to what Paul Krugman was saying about the fact that tax rates don't matter, that they don't matter in the States, that they don't matter across the world? He says Sweden is a huge success story and they have high tax rates and a socialist system. What would your response be?
Well, have any of you seen Sweden? I don't know what country he's talking about. No death tax, cut the corporate tax, cut personal income. I mean, they're the most pro-growth country in Europe. They're the only ones that didn't do Operation, QE1, QE2, QE3. They've got the kroner is doing well. It's not part of the euro with Draghi and Benny Bernanke and all the. I mean, so you talk about Sweden. I'd use that as an example for me. If you would. But if you look at worldwide, the whole stuff you've done, Steve, and all your work on those countries that have had the fastest growth, the best performance have always been those that have low and have cut tax rates. 2 things matter. The level of taxes matters, and also the change in taxes matters as well.
So you mentioned Jerry Brown. Obviously, that was a seminal event where you had a leading liberal Democrat talking about the flat tax. But today, the Democrats, a lot of them would support what Bernie Sanders talked about, rates of 50, 60, 70%. Do you see any Democrats that those of us support tax reform can work with to get this done?
Yeah, if I can take you back in time, I mean, to me, today is exactly 1980, 1979, 1980. I've been to this barbecue before. At that time, neither the Republicans nor the Democrats really believed in anything we're talking about. We had a couple of wild off situations. We had the 78 Tax Act. That was Steiger-Hansen.
That was what, capital gains?
Capital gains, and I think there were 90 co-sponsors in the Senate, if I remember. Howard, you'd remember that. I think it was 90 co-sponsors in the Senate. Once that went through, I mean, the president didn't want that, but even Reagan was very tepid on tax cuts, just to be honest with all of you here. And the Democrats at that time were not. I mean, Carter was not us. But once you start, and let me tell you, you guys who are young, once you start with a little bitty tax cut, it worked. Oh my God, it worked. Let's try another one. it becomes an avalanche, it becomes a cascade, it becomes a waterfall. I mean, by 86, the reason it was 97-3 is everyone was trying to find another thing they could cut a tax on. If it swam, they cut a tax on it. If it jumped, they cut tax on it. If it slept, they cut. I mean, this was a conflagration of tax cuts across the world, leading to this enormous prosperity of the planet. Because once this thing starts rolling, people, you can't stop it. And it's our day. The time has come. These guys have backed themselves into the corner, and they can't go any further. Now it's our day, and once it starts, believe me, it's more fun than anything you've done ever.
So we've been working, the two of us, with Larry Kudlow and Steve Forbes, with some of these presidential candidates to try to get them oriented towards growth. We talked about the plan that the Rand Paul has put into effect. What do you anticipate other of these Republican candidates coming out with, flat taxes?
I anticipate every single one of them will. Right. I anticipate Ted Cruz will, Sean. I anticipate that, even Huckabee is talking about, it's not his primary target area, but he's talking about, and he's talking about a fair tax, which, there are all sorts of different ways. It's not.
What about Jeb? Do you think Jeb Bush will?
I think Jeb Bush definitely will.
You've talked to him, right?
I had a little fun with him. I said, "You're the best of the family," and he says, "Listen, for you, watch it. I come from a stand your ground state." Jeb Bush is one of the finest guys going. Really very impressive. We've seen all of them. Right. Scott Walker. This is a field of candidates. If I can honestly say. Each and every one of these candidates, and there are two I don't know. I don't know Donald Trump and I don't know Santorum. I don't know those two. But the others, I can assure you that each of these candidates has the wherewithal to be a great president. And all this, what you're looking at in the presidential race, and again, forgive me, I know all of you think that people are born with principles and all that. Politicians are a group of people who are united by one characteristic, that they all had bad mommies. You know whether you've done the job well or not. Your mom taught you to judge yourself. Someone says you did a great job. No, I didn't. I didn't do it. These people do not have an internal compass. They don't have a value system. So they always look to external approbation to confirm their own self-worth. That's why they sit in front of mirrors for days on end. I would guess Ronald Reagan spent 3 hours a day getting. You ever see a picture of Ronald Reagan or Jack Kemp? Not perfect. These guys always look as how the rest of the world looks at them. You want to find a fun one, go to YouTube and look up Jonathan Edwards' I Feel Pretty. If you haven't seen that thing, these guys always, if a politician gives a speech and everyone boos, they change their speech. And what you have here is the perfect defining grounds, the training grounds of politicians. These guys are out there trying their ideas with the moneymakers, with the polls, with all this stuff, and they're going to change their views. I believe that the final candidate to pop out will be the one best trained in this process and will be a huge, huge winner.
Now, the one candidate who hasn't really been singing this tune on the Republican side of the aisle is Marco Rubio, because he does have this big child tax credit, which is not our idea. It's not something that we would necessarily support, but have you been able to talk to Marco?
You and I have, I don't know about you, but I've made mistakes in my life. And what Milton Friedman always used to yell at me, he said, "Arthur, make a mistake. If you make a mistake, make it only once. Don't keep hanging on to the stupid answer you used to give. Change it and stop making that mistake." And I expect a lot of these candidates will learn that they aren't PhDs in economics. These candidates are probably, each of them thinks that he or she is the single best brain that's ever walked the planet Earth, and they have the correct proposal for every field. But let me tell you, I would not go one-on-one with Ben Carson on brain surgery. I just wouldn't. That guy really doesn't know how to do it, and so if he suggests brain surgery, I would defer. But when he comes to tax plans, he may not be the right one. Mm-hmm. And these guys are all sitting there trying to figure out how to get one. And the hubris of some of these candidates, because they are young, they're very successful, the hubris of some of these candidates is they think they can define a tax plan better than someone who actually knows what they're doing. That will change as time goes on, and they will become more and more mature, and they will learn from the field around them, and they will become better and better candidates. That's why we have a primary, people. That's why young people finally grow up. Oh, God, did I hate those lines when I was young. But it's true. You know, these guys will learn through the process, and you're going to get a great set of policies out of these candidates. Each and every one of them, I'm telling you, I know them, each and every one of them has the wherewithal to be a great president. Some of them are enormously accomplished. I mean, if any of you have ever seen Ben Carson's, what he's done, I mean, do any of you, I mean, separated conjoined twins, and both, Siamese twins lived? I mean, that's amazing. I mean, Ted Cruz, what has he argued, 9 cases before the Supreme Court? Hello, he's 12 years old. I mean, he's not.
No, that's Marco Rubio. No.
Yeah, but Marco Rubio is young too. He was Speaker of the Florida House. Right. This guy did amazing stuff. They're allowed to make mistakes as they go along, and they'll change, and they'll get right into the groove. And
all right, well, we have about 7 minutes. We have time for maybe 2 or 3 questions. If anyone has any questions, why don't we, are you going to give folks, okay, why don't we start with this gentleman here.
Hi, this is Tip Ghosh. This is a question for Dr. Laffer. Governor Walker mentioned the Laffer curve in his speech, both in his introduction. So if you have any comments on the fact that he mentioned and he talked about broadening the tax base, and so I thought that was interesting.
I was going to pay him a lot for doing that until I found out he replaced it with a coal curve. But if you know Scott Walker, I knew him since he was county executive and all the way through. This guy's amazing. I mean, standing up, he got the right. Wisconsin's a right-to-work state. Hello? I mean, this guy withstood how many recalls and how many elections he had? Scott Walker is made out of pure grade gold. I mean, just phenomenal person. He's in the process. And, you know, each one of these guys has his own thing, and I'm just a huge fan of Scott Walker's.
Yeah, we've met with Scott Walker, and I think he's going to come up with, on this tax issue, I think he's going to come up with something very, you know, big and bold, and I think it will, you know, will include Laffer curve, the kind of Laffer curve effects. But there's no question that Scott Walker is the real deal, and I think he hasn't come out with a tax plan yet, but I think you're going to be very happily surprised to see what he comes up with. Peter.
All right, I think the 1950s proved that the kind of tax rates that Thomas Piketty and Bernie Sanders want can work as long as it's accompanied by an international bombing campaign of all our international competitors.
That speaks for itself.
Yeah. I want you all, please, to pull back a little bit. Remember, taxes matter, and they matter a lot, but they're not the only thing that matters, and they really aren't. Government spending matters. Tariffs, quotas, restrictions on trade matters. Monetary policy really matters. When we came into office on January 20th, 1981, the prime interest rate in this wonderful country of yours was 21.5%. Can you imagine what the country would look like today with that? Regulations matter. I mean, back in the 50s, we had blue laws, we had retail price meeting, there were no discount stores allowed. So when you look at this world, remember, it's not just taxes. It's all sorts of things together, but don't ever forget taxes matter, and they matter a lot.
You know, there's a left-wing ideology that is the intellectual class of the left, and the fact that Thomas Piketty's lunatic book became a bestseller tells you a lot about where the left is at in their thinking. And I don't think any of us, you know, Dan Mitchell or myself or Alan Rabushka or Laffer are going to persuade those people. I mean, they are hardcore income redistributionists, and they drink that Kool-Aid. But the reason I'm optimistic, I wonder if you'd agree with this, is that if you talk about the base voters of the Democratic Party, working class Americans, they do get this, don't you think? I mean, they understand the importance of tax rates. They understand if you tax the employer, there's less money for for hiring more workers and so on. And it seems like we need to do a better job of communicating that message. But I just don't see the American people in favor of 70, 80% tax rates. Do you?
No, I think you're completely right, Steve, on this thing. And also remember that the Republican Party does not have a leader. So they don't speak with one voice. As soon as Reagan was nominated in 1980, he was the leader, and everyone lined up behind him. You can't believe the power of once the Republicans have a nominee, and that nominee is the leader, the convention is set, you'll find all these disparate sort of trying to herd cats, as they say it. They'll all come behind the line, and you'll see the Republican Party become speaking with one voice. Right now, it's very hard to even discern what's going on in the Republican Party with how many candidates are there?
18 or something.
18, well, that's 18 top one. I mean, when the ex-governor of Virginia is not included in that 18, you got a lot of candidates.
Well, Hillary, I think, has a problem here, too, because when she gave her speech, which was actually a week ago today, her whole theme was, how do we help the middle class? I think she didn't call them the working class Americans, she called them everyday Americans. How do we help these people? And she had a big problem. Her problem is that the everyday Americans that she's trying to reach out to have gotten creamed in the last 6 years, right? These are the people who have been the victims of Obama's policies. I mean, if you look at the Census Bureau data, Peter, you've looked at it. I mean, the average family, the middle class, who she says she speaks for, has lost $1,000 of income during a recovery. That's never happened before, where you had middle-class people declining in a recovery. And one of the themes that she talked about over and over again in her speech was, how do we get businesses reinvesting in America? Because it is true, American businesses are very healthy. They've got, $1 trillion to $2 trillion of capital. She said, we need these companies to reinvest. And in the same speech, she talks about raising the capital gains tax and these taxes on the very people she wants to invest. If you want less of something, you tax it. And it seems like she's got a big inconsistency there. Wouldn't you agree?
Yeah.
One last question, then we'll wrap this up. Dennis.
Thank you. I appreciate you continuing to mentor Steve, even though he's into his 50s. It's very good of you.
I'm so much younger. Oh my God, so much younger.
I happened to be here in the 1990s when some of this was going on the Hill, and it was interesting to hear.
Army, right?
Yes, I worked for Mr. Army. It was, yes, it reminds me of how, with the exception of NAFTA, we kind of the Republicans dragged Bill Clinton into all of these tax and spending policies, which you mentioned, with the exception of NAFTA. And I remember these fights.
No, not with the exception of NAFTA. We did NAFTA with Reagan. We just couldn't get it through. It took a Bill Clinton to get it through.
Right. But so the spending, if you in the future want to give this rosy rear view picture of the Bill Clinton economy, it would be helpful to at least contrast that with the modern Democratic leadership and party and say, these folks today aren't for any of these policies that Bill Clinton, where he signed the bills on spending cuts and tax cuts and all that stuff.
Forgive me if I can. You're right. You're completely correct. But in 1979, 1980, there wasn't a goddamn Democrat alive that was in favor of it either. If you look at those guys, you may not remember Tip O'Neill and Jim Wright and Dan Rostenkowski. They're jokes now, but they weren't funny back then. They were the exact same as Reid, Pelosi, and Obama. I mean, when you look at today, don't think that those Democrats cannot become us. They can. They will. They need our big tent. They don't need a closed tent. We need to accept them into our fold. And once they get in, they'll do what Al Gore said to me 6 months ago. He said, it's the best bill I ever voted for in economics, led to 20 years of prosperity. He loves his vote for the 86 Tax Act. Go read what those guys wrote in that time, in that place, in that situation, what they said this would do. It makes Steve Warren and me look like left-wingers. That Schumer wrote that.
It is an important point, though, that the reason Hillary's speech was important last week is she basically said, if you elect me, you're not going to get a third Bill Clinton term. You're going to get a third Barack Obama term. And I don't think the American people want a third Barack Obama term. The party is clearly being shifted to the left, which I think is extremely discouraging, right? I think it's so discouraging that those ideas, those new Democrat ideas, have been cast aside, which actually makes it all the more important we get these guys on the Republican side of the aisle at least to embrace this idea. And I think just in closing, since I see you're hyperventilating there, Paul, just in closing, the fact that you've got 18 Republican candidates out there for president, and 15 of them or so are talking about these ideas, that's a real breakthrough, because we had problems getting Republicans in favor of these ideas in years past, right?
Very much true. And you know, but what I'm asking you, and Steve's not changed, stay open to Democrats, work with them, bring them on board. It's all of our country, not just one party's country. Please, please, please educate them, work with them. And you know, every now and then, they may have something to teach us. So please, it's one country, one people, one vision, one future. And we work and have these things out in the primaries, but please be that way.
Thank you very much.
Thank you, Steve, very much.
Thanks again to Steve and Art, and thanks everybody for coming. Before we close, we're going to have another tax event later this fall, probably in October, so stay tuned to that announcement. And I think there might be some sandwiches and drinks and cookies and stuff out there, so help yourself, and thanks very much.